Hello, everyone joining. We're just going to let people join over the next minute or two. You are in the right place for this training on the ISSB standards, and we'll get started momentarily. Thanks for joining us. Thanks to those that are still joining. We're just going to give everybody another minute to join, and we're going to get started. Welcome, everyone. We're looking forward to this training with you. Great. Thanks, everyone, for joining. It's great to see so many people joining today from the Saudi exchanges market. We're just going to get started with a few introductions. We have a full morning together today, so we appreciate you spending this time with us to increase your knowledge on this training course on applying the IFRS Sustainability Disclosure Standards that we're very pleased to be hosted today by the Saudi Exchange. And I'd actually like to allow some opening or welcoming comments from the Saudi Exchange. Mike, if you can pass us just to the next slide. Great. A big thank you to Mashael for not only hosting us today, but coordinating with us and ensuring that this training could happen for your exchange, and really being one of the first stock exchanges to host this training together with the IFRS Foundation. Mashael, I'd like to point over to you and offer you the opportunity to provide some welcome remarks today.
Thank you so much, Tiffany. Assalamu alaikum. Shukran للجميع على حضوركم. Allow me to proceed in English for the benefit of our non-Arabic speakers. Good afternoon, everyone. Thank you for taking the time today to join us. My name is Mshal Swedem, and on behalf of the Saudi Exchange, I would like to welcome you to today's training session in collaboration with our partners at the Sustainable Stock Exchange Initiatives and delivered by our expert colleagues at the IFRS Foundation. Now today, more than ever, we understand that ESG is becoming an investment requirement globally, and we are committed to encourage sustainable financial growth in the Saudi capital market and have focused our efforts to align with international best practices and the Vision 2030. We are very proud to have introduced our first ESG disclosure guidelines back in 2021 that were developed in line with the UN SSC guidance for the Saudi capital market. Since then, we have introduced a number of initiatives such as our ESG advisory support, our ESG awareness webinar series and training session to offer support and guidance to our corporates throughout their ESG reporting journey. Today, the ISSB sustainability disclosure standards are gaining wide acceptance globally, and we hope today's training will provide you the knowledge and the tool you need to navigate the ESG reporting landscape and align with global best practices. Once again, thank you for joining us for this session today and for your support and interest in creating a more sustainable financial system in Saudi Arabia. Now I'll hand it over to my colleague to proceed with the session. Thank you.
Thank you, Mashael, and thank you to the Saudi Exchange for not only hosting this training, but also being an official SSE supporter. We're very pleased to be working with you now and in the future. This is really a collaborative effort. As Mashael noted, this training is facilitated with the experts on this topic, really direct from the source of the standards, and we're so pleased to continue our collaboration with this great group of people. And we're very honored today to have with us Lee White, who is the Executive Director of the IFRS Foundation. And I'd like to pass over to Lee for some opening remarks. Over to you, Lee.
Thank you very much, Tiffany. Let me first of all express, and I can see there's some comments coming through in the chats, so good morning and good afternoon to all, but let me pass through my thanks to yourself at the SSE and to the Saudi Exchange. This is actually a really, for me, a really important milestone to just be able to open and to welcome to this level of training. Why I'm quite excited about it is that for quite some time, the focus of the foundation and the ISSB has all been around preparations. It's either been preparations leading to originally COP26 and the announcements of the ISSB, preparations to actually the release of S1 and S2 that happened in late June of this year, and even some steps after that. But today represents more deeper, practical, starting to really come to grips with the requirements of the standards and how they can actually be applied and used. And that, to me, is really the testing point, the substance of the work that's already happened in terms of the development of the standards to actually start to see and how they are used in practice. So very privileged to see this training coming together. Hopefully we start to get a real sense of your feedback and views around the application of the standards. That's going to be important from our perspective, and ideally for you to start really getting a sense around the requirements and the nuances that have been built into the standards. If I may say just one further matter, and then I will pass to my colleagues who will undertake the training. I'm an accountant in my DNA. When I first started to engage with S1 and S2 and the earlier drafting of those, it was really helpful for me to put aside some of my core accounting fundamentals and think about these standards in quite a different way to what I'd been trained and engaged with. Not to leave behind the accounting side of things, but not to allow that only to be the dominant part of our thinking. And by doing that, I think you're then able to understand and value more of what the requirements are in both S1 and S2 in a broader sense than perhaps I might have approached them as well. So let me leave those comments in again to welcome everyone, to say thank you very much to our host for bringing this together, and let's bring on the training. Thank you.
Thanks so much, Lee. And I love that idea of taking your accountant hat off for a little bit. As you'll see in the comments, we have quite a few people from a range of different backgrounds. So I think we're able to work together now with accountants and non-accountants on the same topic.
Fantastic. Thank you, Tiffany.
Great. Thanks so much, Lee. Thanks, everyone, for already engaging in the chat. It's great to see your questions coming in. I'm going to go through a few little housekeeping items before we get started so that we can get the most of this training. And if we just go to the next slide, please, Mike, we'll just cover then a few housekeeping issues. So I have seen a question already about what's the difference between sustainability disclosures and climate-related disclosures, which we're going to dig far into that with S1 and S2, and Lois is going to really show us the difference between those. But please put our questions, if we can, into the Q&A. So we will try to answer every single question you send to us. We want to make sure that we make the most out of this interactivity we have together, and we have a full afternoon, morning, depending on where you are, together, 3.5 hours of training. So make use of that time with all of our experts, and please do ask those questions. We also will be asking you questions, and we often use the poll function in Zoom to do this. Unfortunately, that function just went a bit awry just today, so we're going to be asking you to speak with us through the chat, to answer our questions through the chat. And we also use Mentimeter, which is an online tool to be able to discuss different activities and work on a homework assignment that we have for you. So if we move to the next slide, Mike, we then have exactly how Zoom works. I think many people are familiar with Zoom now, but just to remind you all, that Q&A box, so the two little bubbles that are interacting there, we want to see your questions there. We keep track of every single question that comes in, and we can make sure we answer them all for you. So please make sure that you put your questions in the Q&A. You can use the chat to talk with your fellow classmates. However, we might miss them in the chat because they move quite quickly. So if you put them in the Q&A, it makes sure that all of us as presenters, as the facilitators, can see them, and we make sure we answer them. You are on mute, so you cannot speak, but at the end, if we do have time, we can always unmute you and allow you to ask those questions. Then if we move on to the next slide, we can continue to just give you an overview of your presenters. I'm Tiffany Grabski. I'm the head of the SSE Academy at the United Nations Sustainability Stock Exchange Initiative. And I'm joined today with my colleague, Mike Zimoni, who's a senior specialist here. And he happens to also have worked at the IFRS Foundation as well as CDSB. So he knows well this arena and has seen the development of these standards firsthand. So a wealth of knowledge to bring to you today. And that's together with the IFRS Foundation too. So we also have two facilitators here with us today. From the IFRS Foundation, we have Jarlath Malloy, who's Director of Strategic Affairs, and Lois Guthrie, Senior Technical Advisor, who both know these standards inside and out and have a wealth of knowledge from their previous roles as well, not only working on reporting, but also right in companies, in accounting, advising, etc. So please do ask any of your questions, and we'll do our best to answer them with all of our knowledge. We also have Vanina Vijetsi from the SSE, who's making sure that this Zoom is functioning and working and answering all your logistical questions. So if you're struggling at all with any of the technology, please do reach out, and she'll make sure that you can access everything you need access to. She'll also be sharing in the chat the link to our website where we have these slides. So all the content we're sharing with you today, you have those slides. It's right on our website, and she'll be sharing that with you multiple times throughout the training, and your homework. So everybody's going to get a bit of homework today. We'll talk you through it throughout the training, but you have that homework online at that website that Vanina's just popped in the chat. So please make use of that and continue to enhance your learning even after our time together today. If we want to just move to the next slide, great. Just to introduce you to our training today, we really broke, someone said, how many hours is this lecture? It's 3.5 hours. So make sure you have a coffee or water. We're going to be here for a little while. We're going to walk you through 4 steps in your disclosure journey. We're going to talk today about how do you prepare for your disclosure journey. What is the landscape that you want to be aware of, the terminology, the purpose. We're also going to talk about then how to align your current disclosure with the frameworks out there, and what does it mean to be applying the new standards from the IFRS Foundation. We're then going to look at the implementation stage, really in practice. What does this mean? What processes do you have to put in place? And then finally, communicate. How do you communicate this with the audiences that you're looking to communicate sustainability related financial information? And so that includes 4 modules. And on the next slide, we'll see a little bit more detail of those 4 modules. The first one, prepare, will be building on existing knowledge of the landscape and purpose of sustainability related financial disclosures. Module 2, as I mentioned, is really looking at applying those standards and understanding how these standards set that global baseline that you can then build on for any additional regulatory needs you might need to meet, or geographical or sectoral requirements. Then we'll look on those processes and practices through identifying, evaluating, and integrating sustainability related risks and opportunities, and finally communicating that. And if we move on to the next slide, then we'll look at how we're going to practice that together. So we're going to give you, as I mentioned, a little bit of a homework assignment. And that homework assignment is to develop a draft reporting strategy for your company. And you'll be using what we discussed today. So after each module, we're going to do a little activity together, and that will give you an opportunity to start building up that strategy during our training. But we do ask that you take the time after the training to complete that strategy and to really think through how you can make use of everything we did today in order to start moving within your company and making sure that your reporting strategy does indeed include all the requirements of the IFRS standards. And great. And you're not alone after we finish this training together. Of course, ask away all the questions you have, and we'll do our best to answer them here. But when you do leave us today, as you're working on that homework assignment and starting to implement all the practices that we're discussing today, please make use of the ISSB Knowledge Hub. This was just launched recently, so we just applauded all the hard work of the IFRS Foundation at COP28. Which took place, well, just finished today actually in Dubai. And we're continuing to send more and more resources the IFRS Foundation's way in order for them to have kind of one central place that you can find resources that you can trust on this topic. You can also use, on the next slide, we have a really good resource from the IFC, and this is called Beyond the Balance Sheet. So you have the website there or also on the QR code. And this is a project that's been developing over a number of years. We have with us from the IFC, Relitsa Germanova, who was instrumental in developing this tool. And it's really a one-stop shop for looking at disclosure more broadly and really focusing heavily on corporate governance. This is really a great tool as we're discussing corporate governance today, to look at different tools you can use on enhancing your corporate governance. And as mentioned, this is a public good. So it's not only for companies, but it's also for regulatory authorities, stock exchanges, etc. So it's helping everybody get on the same page here as well. If you have any questions about that, Relitsa is here, so please feel free to ask those questions. And then just a quick review of our agenda today. I'm gonna go through this, skip past this one, but just so everyone knows, it is 3.5 hours today. We're gonna go through each module and have an activity with each one. But please prepare yourself for a long session today of learning, and please ask us questions so that you can get the most out of it. Now we're just going to launch a Menti. So Mentimeter is a tool, and we don't have to actually share this one, Mike. We'll just keep it on this screen. Mentimeter is a tool that you can use. So if you take your phone actually and you open up the camera and use that QR code, it should open up a screen at Mentimeter that's asking you, in 3 words, tell us why you've joined today's training. And so you'll get a screen just like that. Oh, there we go. And if you just take a moment to tell us why you've joined today's training, that would be great. And then we'll have one more question for you after that. And Mike, if you want to just share with us a few of those words that are coming through, that would be great.
We're happy to. Oh, they're coming in already. Curiosity, I like that. Of course, disclosure is there. That's the purpose of today's session for sure. Preparation comes up as well as a good one. This is certainly something that's coming many companies' way, so good to get started now. Learn a lot of learning in there, and knowledge comes up as the strongest one, of course. I think this is I like the preparation word in particular. It's something that's coming many people's way. So good to get ahead of the pack in this respect.
Right. So if we move to the next Menti, then Mike, we'll see where everyone's at right now. We just like to get a sense of where everybody is when we get started on our training. It helps us adjust our training, but also it gives us a sense of how much you learned throughout the training. So it should have, if you change it on the Menti itself, it'll change for everybody's screen, and you don't have to every time reopen Menti. If you keep it open, let's see, I'm going to type one in. Okay, you should get the next one opening, which is how comfortable are you with each of these tasks? So we want to know how comfortable you are with explaining to team members the purpose of the ISSB. We want to know how comfortable you are with identifying the sustainability related information investors need. and how comfortable you are with developing a sustainability reporting strategy. And actually, it looks like we have quite a high degree of comfort in this group. So Jarlath, Lois, you might be getting some pretty expert questions thrown your way because it seems like we have people in this group that are quite comfortable with these topics, which is great. So that means we can take you that extra step further. It looks like the most comfortable task is developing a sustainability reporting strategy, which is also wonderful. So now we can help you to make sure that the IFRS standards are indeed integrated into that strategy to make sure that you're applying the full standards. Great, thanks, Mike. We can move back to the slides, but you can keep this poll running and they can continue to answer that as we continue on. Great. So just quickly, we have 3 objectives today. The first is to help you understand the purpose of the ISSB standards. The second learning objective is to identify what sustainability information investors need. And then finally, of course, to develop a disclosure strategy that supports your preparation for the ISSB standards. And with that, a quick disclaimer that the IFRS Foundation does not endorse any opinion, idea, information, approach, use case, and/or solution mentioned or referred to in the examples that we feature here today. Any content owned or produced by third parties in this course should not be considered as representative of the views or the official position of the IFRS Foundation. We use a number of examples in this training, but that's really just to help you understand how this works in practice, and they're really just educational examples. It's not necessarily to say that they're best practice or the way that everyone should be working, but rather to help you understand how to apply these theories into practice. All right, so moving on then, I would like to pass over to my colleague, Mike, who's going to take you through this first section on Prepare. Over to you, Mike.
Thank you very much, Tiffany, and welcome once again, everyone. So let's kick off the content by starting with what you already know and build on the foundations that you have built throughout the years of reporting, because many of you, of course, are not starting from scratch. And that's really the first step of our 4-part session. This Prepare session is broken down further into 2 subsections. We'll first talk about why this type of reporting is so important. We'll talk about the purpose of sustainability-related financial disclosure, and then we'll talk about the landscape, where this IFRS sustainability disclosure standards came from, and how what was already out there evolved to make place for these standards. Let's start with why. That's very important. Now, I'm sure I don't need to talk about this too much, but we all know that climate change and other sustainability risks and opportunities are high on the agenda. Every year, the World Economic Forum publishes its risk report, and more and more every year, climate and other sustainability issues are rising on the agenda. On the short term, in the next 2 years, cost of living crisis, of course, is an important element. But if you look at the different type of risks that have been highlighted, the green ones, environmental, for example, or societal, all relate to sustainability-related issues. And if you look even further down the line, across the next sort of 10 years, virtually all of these risks relate to sustainability-related matters. So these are important issues that are affecting our global society and economy, of course, and therefore it's an important element as issuers of stocks or bonds and other sort of elements. It's important to communicate with your investors about. What does this mean in particular for a company? And here we see some information taken from NL's integrated annual report from last year, where the company outlines some of the sustainability-related risks, in this case, climate-related risks, how it affects the company, and how it sort of be impacting its operations in particular. So these are not just hypothetical risks. These are risks that are affecting companies now and certainly in the near term as well. And as such, companies, investors, lenders need to know about this information. And this, investor-related disclosure is a main reason for why companies might want to disclose, but there are, of course, other ones as well. Increasing regulation around this space often includes requirements to disclose such information. It's also an area of competition between businesses, and so differentiating between your peers is an important element by explaining how you are performing better, how you're managing those risks better, and of course how you are taking better, how you're taking opportunities more seriously with your competitors. And this is not just from some sort of theoretical discussion. Investors are asking for this information, and I'm sure many of you have had conversations with your investors in this respect as well. But just to demonstrate what this means, and what the demand is like, a good example is the Principles for Responsible Investment, a membership body of over 700 investor signatories representing almost $70 trillion of assets under management. And this is a membership body that is very outspoken about engaging with their investee companies around sustainability issues in particular. The size of the market is large. This is one piece of research that talks about $1.27 trillion of annual funds a year being invested in such financing, looking at both sort of institutional investment, but even if you look at it all the way down to individual investors as well. So the size of the market is large. This reflects the interest from investors, but also the size of the opportunity for companies to take advantage and attract new investment and long-term investment to support them in the transition to a more sustainable economy. So with that, we have our first Zoom poll, which we'll actually do through the chat function because of our technical difficulties. But this is one way for us to engage with you and make it a bit more interesting, but also to test your knowledge a little bit in an informal way. The first question I'd like to ask you to use the chat function is, what are your reasons for disclosing sustainability-related information? Is it purely compliance? Is it to communicate with management's objectives? Is it peer pressure, perhaps? Your investors pressuring you or asking for this information, or anything else? You can either just write that in, or if you have multiple reasons, you can put the letters in there as well in the chat. Or of course, if there's something else, please do write them out, and we'll see what the answers are. A and D, so compliance and investor expectations coming up as well. Compliance coming up a lot, I can see that. Communicates management objectives coming up as well, excellent. E, to get good ESG rating, absolutely. This is a great opportunity. We will often talk about risk in this session, but opportunity, where there's risk, there's opportunity, of course. So taking advantage of these opportunities will be important as well. Great. Okay, looks like this way of communicating with you is working as well. That's excellent. So we'll keep using that as we go through the session. So let's move on to the second element of the prepare section, which is, the landscape of the reporting and how we got to the ISSB and the IFRS sustainability disclosure standards. And we have another question for you to get this going. And this is, again, to look at your landscape, so to speak. Are you using any frameworks already to disclose sustainability information? You might be using just one, or you might be using multiple. So if you wouldn't mind, again, putting this in the chat, that would be very helpful. Oh, apologies, I'll go back. There we go. Okay, so let's see. Okay, seems like GRI is a common one in the market. TCFD coming up as well. CDP as well, an integrated reporter as well in there. Oh, someone said ISSB. Excellent. Well, that's be excellent. Interestingly, the European Sustainability Reporting Standards also came up. We'll touch on that just in the next couple of slides, actually. It'll be interesting to see how sort of requirements outside of your country or your jurisdiction might be impacting you. It seems like a number of you are reporting with, using a number of different standards. And this is really one of the reasons that the ISSB and the IFRS Sustainability Disclosure Standards came to be. We had a landscape of a number of initiatives, innovating and bringing and developing, pushing forward this evolving, quickly evolving and very new area. And we really reached a point where it made sense to join forces and combine these different approaches to really simplify the landscape and streamline it, both to make it more easier for companies to report, but also for investors to receive standardized information that's consistent and comparable between companies. And really, this is where the ISSB came from. Some of the major investor-oriented initiatives, CDSB, integrated reporting, and the SASB standards came together and consolidated into the IFRS Foundation to form the foundations of the ISSB's work. Now, a number of you have mentioned that you are using the TCFD recommendations, Task Force on Climate-Related Financial Disclosures recommendations, and these actually formed also the foundations and the core structure of the standards, again, with the aim to further standardize and simplify the landscape of reporting. Some of you have mentioned also the CDP questionnaire, very helpful tool as well. And CDP just last year announced that they will be aligning their questionnaire with these standards as well, further simplifying the landscape. So if you are you are reporting using CDP and then you are also using ISSB, you don't have, you have a much more streamlined work stream going forward as well. So we talked about the sustainability reporting landscape, and there are sort of two areas of this space. One is around the investor-oriented reporting side, which is where the IFRS Sustainability Disclosure Standards live. And then you also have a multi-stakeholder reporting element, which is where the GRI standards are very useful. And these two elements really sit alongside each other, complementing each other. But beyond sustainability, of course, I saw a number of CFOs and other financial professionals on the line. It's important that this disclosure also aligns with financial reporting and accounting as well. And this is no coincidence that the ISSB sits in the IFRS Foundation alongside the International Accounting Standards Board and the IFRS accounting standards. The standards of the ISSB were designed to be compatible with IFRS accounting standards, and often some of the core content of the standards and concepts actually are taken from the IASB's standards as well. But the standards are actually financial reporting agnostic. So whether you are using IFRS standards for your financial reporting, or for example, you are also let's say a US incorporated company and have to use US GAAP, the ISSB's standards do not, there's no issue. You can still use these standards for your sustainability reporting. Building on these different types of reporting, I just wanted to present a different way of thinking about it. And this is from the perspective of materiality. So you have generally three types of views of materiality. And this again goes back to the purpose of why you are reporting such information. You have financial materiality, which is really the impact of the environment on the business, its prospects, its financials, and really with the primary aim of informing your current and your potential investors or lenders. Then you have the impact materiality view, which is another way of thinking about it, is the impact of your business on the environment. And it's often, and I'm generalizing here a little bit, but it's often more interesting to other stakeholders, such as NGOs or governments or others, customers perhaps, to understand that aspect of your business. And then you have the double materiality view, which is really taking these two concepts together and putting it under one umbrella. The IFRS sustainability disclosure standards really focus on the financial materiality view, but again, all of this work has been designed to be compatible and in mind with the other types of materiality, so that they can be used alongside to be informing different types of stakeholders and purposes, of course. Now, I did talk about the IFRS Foundation just now, and perhaps it's good if we spend a few minutes just digging into what that organization is, just so you know where the standards are coming from. The IFRS Foundation is a nonprofit organization really designed to operate in the public interest, to set high quality global standards for adoption by governments for companies. You might be familiar with the International Accounting Standards Board, the IASB, which set IFRS accounting standards, and the ISSB, the International Sustainability Standards Board, and its IFRS Sustainability Disclosure Standards are sitting alongside the IASB under the IFRS Foundation's umbrella. This is, again, going back to my previous slide around making sure that this information is sitting alongside financial information, is linked to it, and can be really digested at the same time. These two boards are overseen by the IFRS Foundation trustees. This is an international group of trustees, including a representative from the Saudi exchange as well currently, and these trustees are then overseen by an international monitoring board of regulators under IOSCO, which is the International Securities Regulatory Organization. Now, the ISSB was set up for a number of reasons, but its main objectives are, of course, to develop a global standard for adoption for the reporting of sustainability disclosures. As I mentioned, their purpose is to meet the information needs of investors, and really by enabling companies to provide comprehensive sustainability information to those investors and capital markets. Given that these are designed to be adopted globally, it is important that these are designed in a way that they facilitate interoperability with disclosures that are jurisdiction specific. So if there are any jurisdiction specific requirements, or as I mentioned, aimed at a broader stakeholder group to inform those stakeholders as well. And this is, of course, what the standards do. The standards do this by acting as a global baseline of disclosures on which additional elements can be added, whether that's those jurisdiction-specific requirements or broader stakeholder needs as well. But importantly, that baseline stays consistent and comparable no matter where you are, so that if an investor opens up your report and you have stated that you have reported in compliance with the IFRS Sustainability Disclosure Standards, they know what they're looking at, and they know that they can compare it to a different organization from a different jurisdiction. The standards have been issued this summer, so a couple of months ago, and importantly, it has received wide recognition, including endorsement by IOSCO, which I mentioned earlier, the Global Securities Standards Setter. Currently now, audit standard setters, the International Audit and Assurance Standards Board, is developing an assurance standard for this. This is coming later as well, to contribute to the high quality disclosures, and jurisdictions around the world are working to adopt these standards into legislation. Be that, for example, in Asia, I know that a number of jurisdictions, Singapore, for example, is working, Hong Kong is working in that direction. In Latin America, I know that Brazil is working in that direction. In Africa, Nigeria was actually the first one globally to announce, and there are a number of others who are working to adopt these standards. So these are moving fast. Last but not least, a number of you have mentioned that you are already working on your ISSB disclosures, and that's excellent. So we are definitely seeing a trend of front runners working to adopt these standards as well. And this really speaks to the high quality and recognition of the standards. Now, IOSCO, as I mentioned, is that membership body of group of securities regulators that often do then regulate the standards. And as such, they actually have gone through the standards rigorously to ensure that the standards are prepared to a high enough quality, that they were prepared in an inclusive manner, and that they are suitable for regulatory adoption. And it was just a few months ago, they have announced that after they're going through these standards rigorously, they do believe that they are suitable for this global adoption, and encouraged regulators globally to begin adoption. So now we've got our next poll, and this is around a first question to test your knowledge. I've mentioned, of course, that the standards built on the TCFD recommendations. So the question is, companies who disclose using the TCFD recommendation automatically comply with the ISSB standards. Is this true or is this false? Okay, and we have a smart audience today. It is indeed false, and I see most of you have written that the TCFD recommendations do form the foundation of the standards, but the standards actually go, build on this further and do sort of add to those requirements. So what we are seeing is that those who are already reporting using the TCFD are ahead of the game, but there are additional requirements that actually Lois and Jarlath will get into as we go forward. So Tiffany mentioned that we will be sending you some homework after this, and relating to this section will be the first step of the homework, the first section of the homework around preparing. An important element to prepare is to ensure that you have you think about the capacity of of the staff will be involved in this reporting, and making sure that responsibilities are allocated appropriately. So you need to think about the tone for the top, making sure there's someone in the leadership position responsible and for this project, and pushing this over and overseeing progress. Important to think about which teams need to be involved in this, and making sure they are familiar with this topic and know what to do. And of course, as with any business decision, there needs to be some negotiation, coming to a consensus about responsibilities, roles, and really how you're going to be taking this forward. These are essential steps, and this is really the first homework element. But we'd like to start this discussion now, so that to kind of get you a kickstart with your homework. So if you go on the Menti, and I will quickly move to the next question on the Menti, 1 second. The first question is, what will you do to identify the skills and knowledge gaps in your organization? So the question should hopefully be coming up. If it's not coming, please let me know, and please feel free to add some thoughts on this. Unfortunately, it's not showing up on my screen. I will quickly move and reload up. 1 second, please. Could you let me know in the chat, please, if it's working on your end? No. Oh, it's working. Okay, great. Excellent.
Yeah, we see it, Mike.
Excellent. It's not working on my screen, unfortunately. Jonathan, can you see any of the answers that are coming up?
No, not yet.
All right. If a couple of you if you could put one of your answers in the chat, that would be very helpful. Apologies. Technology is not on our side today, it seems. It's working for some, but not for all. We'll restart this Menti after this question, and I'm sure it'll be working fine. Okay, well, why don't we proceed with the session? I'll have a look at this at the answers, and maybe we can get back to it as we proceed. But we have a lot to go through, so perhaps we move forward. And with this, I believe I hand over to my colleagues in the IFRS Foundation. So over to you, IFRS Foundation colleagues.
Thanks, Mike. Good afternoon, everyone. My name is Jarlath Malloy. I'm joined here by my colleague Lois Guthrie. will take you through some of the detail now on the standards. And thank you to Mike for covering some of the introduction and the initial background to the foundation and the development of the standards. Now we've got that overview, let's get into the details. So if we can move to the next slide, please. We'll split this session into two parts. Initially, we'll look at applying the standards, and a little bit later, we'll cover additional disclosures. So next slide, please. And we'll start with the baseline. Next slide, please. So there are a number of important concepts and terms to be familiar with when we talk about the standards, and Mike has helpfully covered a number of these already. It might be just worth spending just a moment or two to remind ourselves what we mean when we talk about sustainability-related financial information, for example. And this really refers to information about an entity's sustainability risks and opportunities that's useful primarily to investors and readers of annual reports in making decisions relating to providing financial resources to that company or that entity. In S1, sustainability-related risks and opportunities are those that can be reasonably expected and to affect that organization's or that entity's cash flows or its access to finance, or even the cost of capital over the short, the medium, and the long term. And similarly, S2 requires disclosure of an entity's climate-related risks and opportunities, as well as its sustainability-related risks and opportunities. Again, that's useful for investors. Okay, sorry, I was just seeing some comments on the chat. The microphone has been great. I'll see if I can move a little bit closer.
Thank you, Jalith.
Sorry, bear with me. Okay, so we'll move to the next slide then. S1 is the first standard, which focuses on general requirements. And I guess what I would say to all the preparers listening, don't be afraid by what you see in the standards. Yes, there is a lot there when you open them initially to understand. But if you're familiar with sustainability reporting, you might be surprised actually that some of the detail is not very unfamiliar to you. For all of the accountants joining us today on the call, you too will be relieved to see that many of the conceptual foundations developed by the International Accounting Standards Board are also reflected in the ISSB standards. This slide sets out the key concepts in S1, and we'll go through each of these individually today. S1 sets out the general requirements for the content and the presentation of sustainability-related risks and opportunities. And if you're familiar with TCFD, you'll see the same architecture applied to the standards and throughout the standards. You'll also have to consider industry-specific disclosures, and there are multiple sources of guidance which are provided and which are signposted too. And finally, Mike talked a little bit earlier about GAAP. In fact, you should know that the standards can be used in conjunction with any accounting requirements. Next slide, please. So the second standard, S2, focuses on climate-related disclosures and builds on the same approach taken for S1. So, for example, it fully incorporates the recommendations of TCFD. It sets out the requirements for a company to disclose material information about its climate-related risks and opportunities. And it also requires the disclosure of both cross-industry and industry-specific information. In terms of climate risk, these include both physical and transition risks. We'll come back to this a little bit later. Climate-related opportunities refer to the potential positive effects arising from climate change for an entity. So, for example, efforts to mitigate or to adapt to climate change can produce such opportunities. Next slide, please. One of the important things to remember, and this does come up in questions, is that S1 and S2 are not individual standalone separate standards. They're not a menu to choose from. They are designed to be used as a package. And this is because S1 sets out the way in which entities should approach reporting. So, for example, it covers the key concepts. It talks about the assessment of materiality. It talks about the qualitative characteristics of the information. And in particular, it talks about relevance and faithful representation of the information that's included. And it also covers more practical issues such as timing and location and other information. S2 instead focuses on topic-specific requirements on climate change. Next slide, please. Mike talked a little bit about the steps prior to the launch of the standards. And it's important to remember that for many of you who are familiar with the exposure draft process, during this consultation period, one of the key piece of feedback we got was the importance of supporting preparers, and particularly those who have more limited resources or those who are in emerging and developing economies. And the ISSB took this request very seriously. As a result, the board published application guidance, which accompanied the standards. And in many ways, this application guidance can be seen as an extension of the standards. And so if you open the PDF, you'll find it there. Beyond this, the ISSB has been thinking carefully about the education materials that we need to put in place and support preparers. And you'll have seen a number of updates and announcements very recently at COP on some of the materials that we have published and are working on. And in addition, the Foundation announced a new capacity building program at COP last year. And this program with SSE today is a direct result of our collaboration following that announcement on the capacity building program. I think, Lois, I'm going to pass to you now, but just before I do, I have to say that today is Lois's final day with us in the Foundation, and she has been a driving force behind this initiative. We'd like to say thank you for all of your help, Lois, in building this today. Over to you.
You're welcome. Thank you. Hello, everybody. I just want to check first that you can hear me okay. I see some people are saying that the sound issue is back. Oh, thank you.
Thank you for checking, Lois. You are coming through loud and clear, yes.
Oh, brilliant. Thank you very much. And also, I see that we're running slightly ahead of time. And that being the case, I just wanted to answer two questions that I saw coming through, just because I know what it's like to sit in a long presentation and see that your question is not being answered. But yes, somebody asked a question about whether S1 and S2 could become mandatory in many jurisdictions. And as someone else has put in the chat, of course, they're not mandatory at the moment, and it will be for the authorities in the relevant jurisdiction to decide. Some of you might have seen activities in other jurisdictions where authorities are considering what process they should use and whether and to what extent and when the standards might be made mandatory. So it will really be a decision for the jurisdictions. Somebody asked whether Scope 3 would become mandatory, and again, this is provided for in the standard in S2, but will be a decision for the authorising jurisdiction in your country as to whether and when Scope 3 would be made mandatory as part of the standards. So that was just wanted to let you know that we are watching your questions and listening to them. So I'm just going to turn now to talk about the conceptual foundations that for sustainability related financial disclosure that are found in S1. So as Jala said earlier, S1 and S2 apply together. They are not separate standards. S2 is to be applied in the context of what we find in S1. So if we go to the next slide, please, Mike, we'll see that one of the important features of both standards and any future standards that might be issued by the ISSB is that the information is to meet the primary users of general purpose financial reports needs. So these are generally existing and potential investors and other creditors, and they use this information to inform their decisions about whether to provide resources to the entity, whether to buy, sell, or hold equity and debt, to provide or settle loans and other forms of credit, and to vote on or otherwise influence how the company manages its economic resources. So that's one of the fundamental concepts that apply across all sustainability-related financial disclosures. On the next slide, one of the other things that's fundamental to all sustainability-related financial disclosure is that information should be connected. We'll look at some examples of how companies are making these connections, but broadly, the connection should be made between sustainability-related risks and opportunities. And often the risk and the opportunity are opposite sides of the same coin and can be connected. There should also be connections between the core content disclosures. So if the strategy is to achieve a particular target, we would also expect to see that target reflected in the metrics and targets disclosures. If the company has identified a risk, we would also expect that to see a strategy to address that risk in the strategy part of the disclosures. And finally, and very importantly, sustainability-related disclosures should be linked with the financial statements. So we start to see a picture of how the risks and opportunities might affect financial results now and in the future. So if we go to the next slide, please. We have an example here, and this example is from BHP, which is a big mining company based mainly in Australia, but in other jurisdictions. And we're using this example to demonstrate how the company draws connections between their decarbonisation strategy and the investments they make now and the investments they plan to make. So this is what we see being connected: the decarbonisation strategy, the investment process, and decision making. So you'll see right at the top of the disclosure there, the company says all investment decisions consider the quantity of GHG emissions associated with the project, the cost per tonne of CO2 associated with the project, and the alignment with the group pathways to a net zero trajectory. So you can already see there that the company is connecting their investment and their strategy to achieve net zero. You can also see how much was spent on operational GHG emissions reductions and what the company anticipates spending until 2030. So that's in the third paragraph down. We expect to spend around US $4 billion nominal value on operational decarbonisation. Finally, in the penultimate paragraph, and I think expects it to be neutral. I wonder if can you still hear us? Would somebody just pop yes in the...
You've cut out for a second, Lois, but you're back.
I think in response to the question, the operational greenhouse gas emissions are greenhouse gas emissions arising from the operations, as distinct from greenhouse gas emissions arising perhaps through the supply chain or from offices. You know, the companies distinguish these things in different ways. So the other thing I want to note about this example, right at the bottom, you can see some orange text, and that is directing us to where we can find more information. It's a navigation tool. So let's go to the next slide, please. Yes, in addition to being connected, it helps make information decision useful when it is consistent. So consistency is enhanced, as we see here, when the same data and assumptions are used for sustainability-related financial information and the related financial statements. Sometimes that's not always possible, as we see on the last bullet point there, because financial statements tend to look at different time horizons. Sustainability disclosures tend to look at much longer time horizons. We also see consistency in information where sustainability and financial information are prepared for the same reporting entity and for the same reporting period. And when the sustainability related financial information is provided at the same time as the financial statements and in the general purpose financial report. So you see the picture that's being built up here. The conceptual foundations require this connectivity and consistency in order to make information decision useful. And on the next slide, please. Thank you. Fair presentation. Now, those of you that have read IFRS standard S1 on general requirements will know that the provisions on fair presentation are set out in paragraphs 10 to 24 of S1. Hopefully you've all read the standards, and they say that a complete set of sustainability related financial disclosures shall present fairly all sustainability related risks and opportunities that could reasonably be expected to affect the company's prospects. So for sustainability related financial information to be useful and to be fairly presented, it must be relevant and material. It must faithfully represent information using principles of decision usefulness, which include things like we see on the next line, that they should be comparable, verifiable, timely, and understandable. If you look at Appendix D of the standard, you'll see that these terms are elaborated. So to make information understandable, just for example, you would not use too many acronyms or too much jargon that's very associated with your business. You would make it understandable to all of your readers. Importantly, a company should achieve fair presentation by disclosing additional information that is additional to supplement its relevant and material information if needed for understandability. So sometimes things need elaboration, even though we're aiming to keep things concise, relevant, and material. So to achieve faithful representation, the information should have the characteristics of being complete, neutral, and accurate in terms of its depiction of the sustainability-related risks and opportunities. So I see a number of people on the line are from the finance departments in which you work, and these principles will be familiar to you from perhaps from IAS 1 and the IASB's conceptual framework. So on the next slide, we have a Zoom poll. So as Tiffany explained earlier, we're unable to operate the Zoom, I'm afraid, as it is, but we can take your answers through the chat function. So should I return to you, Mike, to go through this? Thank you.
Sure, thank you, Lois. So our question is, in terms of connectivity, which of the following information should be considered?
Oh, Mike, I think you might be on mute. I'm happy to do it if it helps. I'll go ahead. So what we're looking for is to ask you, in terms of connectivity, which of the following information should be considered? Select all that apply. Connections between governance, strategy, risk management, and metrics and targets. Connections between sustainability-related financial disclosures and financial statements. Connections between sustainability-related risks and opportunities. I can see from your answers that there's a lot of gold stars to be given out today, because most of you are saying all three, and that is absolutely correct. All three connections must be made between all of these. So thank you for your superb answers. So I think I hand back to you.
Back to me. Thank you, Lois. So following the conceptual foundations, we're now going to focus on the core content of S1 and S2. So next slide, please. Again, these are the 4 pillars of TCFD, which many of you will be familiar with. And we're going to spend a little bit of time going through each of them in turn. We'll start with governance next, and then we'll come back to strategy, risk management, metrics and targets. So if we could move to the next slide, please. Both S1 and S2 require company disclose information about the governance, the management, and the oversight of sustainability-related risks and opportunities, including climate. And the disclosure requirements include, for example, who is responsible for the management and the monitoring and the oversight of these issues in your organization, the role and responsibilities, and the skills and the competencies of the members of these boards or committees or groups, or however it's set up, what processes and controls are used for managing sustainability-related risks and opportunities, how and when do these groups get informed about these issues, and finally, what sort of decisions do they actually make in practice? And for example, have they set targets that they then manage? Have they and so on? We'll cover some of this with some examples as well. Next slide, please. So the first example is from AIB Group PLC, which is a bank. And what's nice about this example is that it's a very, very simple, very intuitive, but very effective way of managing these issues. So for example, at the top, you see they have the board. There are 3 subcommittees in the board: a risk subcommittee, a sustainability subcommittee, and an audit committee. You've got then the next layer down is the ExCo, and below the ExCo, you've got the same structure: a risk, a sustainability, and a group disclosure committee, which support the ExCo and feed in information to the group, to the board subcommittees. Below that, you have management, first and second line of defense, and you can see the group internal audit at the side. And there's more information in the descriptions below, but it's a very simple, very intuitive way of understanding how the board manages these issues. We could also show you a very different example where these issues are integrated into a different type of setup. So, for example, you might not have a sustainability committee in your organization. Your audit committee may integrate risk in it as well, for example. And the point is, there's no one way of doing this right. You have to find a way that works for you. And there are many models available. And if you have a look in the examples we've provided or elsewhere, you'll see them yourselves. But there's plenty of choice there's plenty of options to choose from. Next slide, please. A second example here in governance goes into a little bit more detail about the kinds of decisions that these committees make. So, for example, this is taken from Toyota's report in 2022. At the top paragraph, it talks about the role of the board, who is involved in decision making. The second paragraph talks about the types of decisions it is making and the types of decisions that affect its strategy, particularly in terms of the risks it has identified. And the third paragraph then talks about the actual actions the board has taken in terms of investment to manage and mitigate the risks that it has identified. Next slide, please. Well, I'm going to move next on to strategy, and we'll run through each of these issues in turn. This is still me, yeah, that's fine. Next slide, please. So, S1 and S2 disclosure requirements on strategy are designed to enable investors to understand the company's strategy for managing sustainability-related risks and opportunities. S1 requires companies to disclose information about sustainability-related risks and opportunities that have been identified by the organization, and also the time horizon over which they are expected to occur, as well as the effect those risks and opportunities may have on the company's value chain, for example, its strategy and its decision-making over time, and importantly, its financial position, its financial performance, and cash flows in the short, the medium, and the long term.
I think you can hand over to me.
Okay, thanks.
Yes, so as we saw, the strategy is to be considered over the short, medium and long term. So how are these time horizons identified? Well, first, it's important to note that the time horizons are not specified in the standard. The time horizons are deliberately not specified because it is for each industry or company to decide the time horizons over which they make decisions and plan their strategies will differ according to their business and their management. So the time horizon could be determined by reference to your investment and business cycles and the periods over which you plan your cash flows. The time horizons could be determined by the timeframes over which you make strategic decisions and allocate capital. Time horizon decisions might be influenced by the assessment periods used by your investors or by the life of your assets. Now, you don't have to stick to one time horizon. You might use different time horizons depending on what you're strategizing for and why. So we have actually put an example of the three horizons framework, a link to that in the slide there. Now, I just wanted to, yes, next we'll talk about the financial effects of your strategy. So we know that the standard says that companies should report the effects of sustainability-related risks and opportunities on their current and anticipated financial performance, position, and cash flows. So financial performance, as those of you from the finance department will know, being your profit and loss, your income and revenue statement, financial position being your balance sheet, what assets and liabilities you have, and cash flows. So the standard, this is one of the most notoriously difficult parts of the standard and one on which we get many questions. But the standard says that although ideally a company would present quantitative information about the financial effects, they can also give information in qualitative form. So in particular, you can make qualitative statements about the financial effects when the risks and their effects are not separately identifiable. So often a financial effect will arise because of a multiplicity of things. So it's not just one risk that gives rise to a financial effect. Secondly, you can provide qualitative information where there's a high level of measurement uncertainty. So where the uncertainty is so great that the quantitative information just wouldn't be useful. And thirdly, qualitative information can be given instead of quantitative, where the company just doesn't have at the moment the skills, expertise, and resources to provide the anticipated effects in quantitative terms. So can we go to the next slide, please? Here we have an example, and this is an example from a company called Solvay, which is a chemical company that is based in Belgium. And this example is used to illustrate how financial effects can be reported. So in this example, we see that the company is estimating some of the financial effects, and this is an important point. Estimates of financial effects are absolutely fine and allowed for by the standard. We also see transparency about how the estimates have been done. So in this case, Solvay has based their estimates of financial effects on scenario analysis. This is one way of doing it, but I should just stress that there's no requirement for anticipated financial effects to be estimated using scenario analysis. It's just that's how this company has chosen to do it. We'll look at other ways of doing it too. The scenario analysis in the standard is primarily used for resilience analysis, but of course that's very much related to anticipating financial effects. So what Solvay do here as well is they describe the scope of the analysis they've done to estimate financial effects. So they say, well, we've limited this to certain transition risks, to certain business units, i.e. those that are most affected, and to the scenarios we've used, which are a 1.5, 2, and 3 degree scenario. They've also used assumptions that they list, and they've used consultants and internal experts. Because this is quite a busy slide, I'm just going to use one example. When I said that the company were transparent about which business units they have calculated or estimated financial effects for, one of those business units is their soda ash business. Because it's one of the most material and relevant for this purpose. Now, soda ash is a key ingredient in our everyday lives. We find it in windows, rechargeable batteries, detergents, and many other things. And actually, back in 1860, the founder of this company invented the process to produce it. And now, even 160 years later, it's a preferred way of producing soda ash. Why am I telling you this? Because that way is very carbon intensive, and Solvay is developing new lower carbon ways of developing soda ash. Now this is going to affect the cost of their raw materials, which cannot necessarily be passed through to customers. So that this will cause a potential decrease in the margin, but they also anticipate a growth in sales by 2050 as demand for lower carbon products increases. So you can see that there's this connection here between the risks and opportunities, between the scenarios and the estimates of future financial effects. So that was the Solvay example. And if we go to the next slide, oh, we have here an example. This example is from Unilever. And again, you'll see from the top that what Unilever are disclosing here is financial quantification of assessed risks and opportunities. So again, Unilever looked at climate scenarios that model global temperature rises of 1.5, 2, and 4 degrees above pre-industrial levels by 2100. So what did they actually focus here on 1.5 degree pathways, and they say the pathways can either be proactive, in which case everything will happen fast and all of the relevant actors will act together so that there will be a clear and fast transition towards a 1.5 degree scenario. And that's indicated by the little p that you see, the little Greek style p in there. They also said, well, what would happen if it was a reactive scenario? And that's shown by the little r that you see on the slide. So the proactive pathway assumes this early, steady, fast action. The reactive pathway says that we assume delayed actions and will need much greater technological solutions. On the left side, you'll see that the company has set out their main risks and opportunities. So there are regulatory and market risks in terms of carbon tax, and there are physical risks from extreme weather. And what they've done, according to the key assumptions that you see listed in the second column, is that over the periods 2030, 2039, and 2050, they're giving you an indication of how much they expect the financial impact to increase or decrease in these two scenarios. There's a lot to say about this example, but I think if we move on to the next slide, we might see other depictions. Oh yes, no, this one, thank you, thanks Mike. So this is an example from a company called Stora Enso, and what we're trying to do here is to give you an insight into the different ways that companies estimate their financial effects. Now on this slide, all we want to focus on is the little green and yellow circle in the top right-hand corner of the slide. Because like Solvay, Stora Enso distinguishes between their existing business and their growth businesses. And what this little circle so impactfully tells us is that the financial growth is expected to come not from the traditional businesses, which are in yellow and will grow by 20%, but from the growth businesses. So immediately you see where the financial growth is expected. So if we look at the next slide, please. Oh, we have another Zoom poll, and I shall read that out to you. Again, I'm afraid we have to take the answers in the chat function, please. So this question is about financial impacts, and we know it's difficult. So the question is, when a company is unsure about the financial impacts of risks, what could they do? 1, A, omit any disclosures. B, make a reasonable estimate. C, explain the financial risk in qualitative terms. D, identify what type of financial impact they expect. In other words, would it affect revenue, value of assets? And E, explain why the company is unsure. Again, we see some very impressive answers coming through here. Whoever has written B, C, D, and E, quite a few of you, is absolutely correct. I think the answer is, if you're unsure, could be tempting to think we'll omit any disclosures, but in fact, the standard allows many different ways for you to communicate these financial impacts to your investors using B, C, D, and E, as many of you have rightly said. So I just want to, just before we go to the next slide, just say to, is it Majid Al-Qatari, we see your note about your questions being answered, and if you would like to copy and paste your most important question into the chat, I will try and get to it just as soon as possible. We're very sorry, we've got so many questions coming through, we can't quite deal with it at the moment. So what do we have on the next slide, please, Mike? Climate-specific strategies. So this is, yes, this is also me. So as we know, S2 deals with climate-related risks and opportunities. And what we're going to look at in this section is just the way in which the strategy content requirements apply to that. So can we go to the next slide, please? Of course, one of the most important things that your investors will want to know about your climate-related risks and opportunities is how you are responding to them as part of your strategy. What is your current and planned response? So your disclosures should explain how you plan to achieve the climate-related targets, whether the response will involve any changes to your business model now or in the future, what type of direct mitigation and adaptation effects you have, efforts you have in place, things over which you have control in your organization that you directly can mitigate, whether you have any indirect mitigation and adaptation efforts in place or planned. So this might be things you're doing with partners in your supply chain. That would be more indirect mitigation. You should also disclose whether the plans already in place, how you're progressing against them, and explain whether you've had to decide to make trade-offs between different sustainability-related risks and opportunities. So quite an example that I've seen of this trade-off is where a company is developing low-carbon products, but that means a great deal of technological change that can mean the workforce has to change as well or be retrained. So there's a trade-off there between the development of low-carbon products and considerations about a just transition for the workforce. So they're the types of trade-offs that one can encounter. So can we go to the next slide, please? Yes, in S2, the climate standard, companies are required to disclose as part of their strategy disclosures whether they have a transition plan. So a transition plan is described in the standard as an aspect of the company's overall strategy that includes targets, actions, or resources for the transition towards a lower carbon economy, including, for example, greenhouse gas emissions reductions plans. Now, the S2 standard doesn't say much more than that, actually. So that is why on this slide, you'll see that we refer to some resources that have been developed by GFANZ, the Glasgow Finance Alliance for Net Zero, and the Transition Pathway Task Force. Both of these organisations, in developing their transition plan advice, guidance and disclosure frameworks, they rely also on the ISSB standards. So what you will see in their resources is built on the ISSB standards. But importantly, we see from GFANZ that they have set out the transition plan expectations of the real economy, of financial institutions, and they've done some sectoral pathway work. And then for specific disclosures, the Transition Pathway Task Force has actually issued a transition plan disclosure framework. So if we go to the next slide, please. Yes, as part of the requirements in S2, under the strategy content requirement, companies are required to assess their resilience to climate risk. So that involves looking at the implications of climate change for the company's strategy and business model, for the company's financial and operational capacity, and the extent to which they can adjust or adapt those things over the short, medium, and long term. Of course, this type of assessment is dependent on using inputs, maybe from third parties, and key assumptions. So relevant scenarios must be used to conduct the resilience assessment, and the company doing this must provide information about which scenarios they've selected and what types of assumptions that they've used. Next slide, please. Yes, now in S2, you'll see that there is some application guidance. It's at the back of S2 on how to apply scenario analysis. And this very much builds on the TCFD materials. So any of you that have read the excellent work the TCFD published on scenario analysis, this will look familiar to you. But many companies find scenario analysis quite daunting, understandably so. And so the guidance does say that the method of climate scenario analysis a company can use should only be commensurate with their circumstances. So with the skills and resources they have available to them at the reporting date. And the standard also says that companies are just required to use the reasonable and supportable information available to them at the reporting date without undue cost and effort. So we saw the example from Unilever earlier, and it does look like it takes some unpicking, but what the guidance says is we're not expecting all companies to be able to move to very sophisticated scenario analysis in the first instance. They should conduct scenario analysis on the basis that is commensurate with their own circumstances, using reasonable and supportable information. So if we go to the next slide, I think we might have an example. Yes, we do. Now, this is an example from Cemex, a cement company, from their 2022 integrated report. In the two orange lines across the top, you'll see they're doing what the standard requires there. They're setting out the types of scenarios that they've used for their resilience analysis. All three scenarios, stated policies, sustainable development, and net zero emissions, are actually produced by the International Energy Agency, and they can be obtained from the IEA. So we know what scenarios that that Cemex is using. Then down the left-hand column in the grey cells, we see that Cemex is setting out the risks and opportunities that they are using scenario analysis to assess their resilience for. For each risk, the company considers both the probability and impact of the risk in these three different scenarios. The probability and impact can be low, medium, or high. So if we just take the first risk on that screen, the reduced market demand for higher carbon products and commodities, we'll see that in the stated policies scenario, that is, we only, the scenario assumes that we only do what is already on the table in terms of policies, the risk to Cemex is relatively low. Nothing much, that's because nothing much will change for them. And you'll see that the risk increases as the scenarios become more ambitious. Now, interestingly, if we go to the first line of the opportunity cell, increased demand for energy efficient, lower carbon products, again, we have this theme of risks and opportunities being two sides of the same coin. You'll see that actually the opportunity increases for them in the most ambitious scenario, right in the final column under net emissions by 2050. So this is an example of expressing the degree of risk using these coloured bars without actually having to quantify the financial risk, but it's still quite impactful, I think. So if we go to the next slide, please. I think this is back to you, Jonathan.
Yeah. So thank you, Lois. We're going to spend some time now looking at risk management requirements, and we'll do this in a little bit of detail. And as a reminder, these are the requirements that are designed to enable investors to understand a company's processes for identifying, assessing, prioritizing, and monitoring sustainability-related risks and opportunities. So next slide, please. Now, I'm sorry, there's a lot of information on the slide here. I'm not going to read it out. I'm just going to talk about it in general. So a company is required to disclose information about the processes and the related policies that we've just talked about, including information about the inputs and the parameters that have been used when thinking about these issues, whether and how sustainability-related risks have been prioritized by whatever board or group is responsible for looking at this, how the nature and the likelihood and the magnitude of the risks are assessed and analysed, whether any scenario analysis is used, and Lois just talked about that a moment ago. How sustainability-related risks and opportunities are monitored. Is it periodic? Is it at each meeting? What does that look like? And of course, all of these will evolve over time within the organisation for lots of good reasons. But we're looking to see that kind of information disclosed to help investors understand what's actually happening within the organisation on these topics. And beyond these issues, the standards also ask about the extent to which all of this information has been integrated into the organization's enterprise risk management process or tool or its equivalent. Next slide, please. Now let's again look at how S1 and S2 are differentiated when it comes to risk. So if we move to the next slide. As we know, sustainability-related risks and opportunities include both transition risks and also physical risks, physical climate risks. So if we take transition risks first, these arise from the transition to a lower carbon economy. And when we talk about transition risks, you often hear people talking about 4 areas. And they include policy and legal, technological, market, and reputational risks. Now, these risks could carry financial implications for a company. So, for example, increased costs or even asset impairment due to climate-related regulations kicking in, for example. And as a result, the company's financial performance could be affected by the shift in technology, but also by the shift, for example, in consumer demand for particular products and services. Physical risks, then, secondly, they include, as we all know, risks from climate change that can be event-driven or from longer-term shifts in climate patterns, and we're all well aware of what these look like. Chronic risks, as I said, arise from longer-term shifts and also include biodiversity loss and changes in soil productivity. And these risks carry financial and potentially carry financial implications for a company. So, for example, this includes the cost resulting from direct damage to the organization's assets, or even indirect costs from changes or disruption to supply chains. And also the company's financial performance could be affected by changes to the availability of resources and extreme temperatures and employee health and safety. Next slide, please. But there are also potentially opportunities which refer to the positive effects arising from climate change for a company. And so, for example, as you mentioned very briefly earlier, efforts to mitigate and to adapt to climate change can produce opportunities for an organization. Also, it potentially allows for improving resource efficiency, use of lower emission sources of energy, and supportive policy or financial incentives, for example. Now, if you think a little bit about it, a lot of that is sometimes abstract, but if you're looking for an example, you could consider a company in your sector which has identified and disclosed a risk or an opportunity, and it might, as a result, benefit from what's sometimes called first mover advantage. Now, an investor could look at your sector and they could see your disclosure and wonder why your competitors or your peers have not identified or sought to mitigate the same risk that you have. And they might be wondering, why are they not doing that? And as a result, they may not be thinking about the same opportunity that you have identified. And this could, as a result, have a positive financial and a reputational benefit for your company. Next slide, please. So there's one example here, which is an air traffic control organization in the UK. As they have identified, there are already challenges which they face from bad weather. These are described as current acute risks and the impacts. These are expected to worsen over time as a result of changes to weather and to climate. But there's also an opportunity, in this case, from a faster jet stream, which might reduce transatlantic crossing times and result in lower CO2 emissions for those aircraft. However, at the same time, there's potential for increased turbulence and thunderstorm activity from climate change. All of these different things will need to be addressed in its strategy, and they will affect its long-term investment plans. Next slide, please. So we come then to the fourth element, which is metrics and targets in TCFD language, if you're still familiar with that. And we're going to review we're going to review metrics and targets individually and spend a little bit of time on this topic. So next, thank you. So when we talk about metrics, there are some key disclosure requirements here. And as you can see, they're listed on the screen. I'm not going to go through them all individually. But requirements on metrics and targets are designed to enable investors to understand a company's performance in relation to its sustainability-related risks and opportunities. Preparers should explain how the metrics are defined, whether they're absolute or relative. For example, if they've been validated or certified or assessed by a third party, and what that method of calculation involved. So, for example, kind of inputs were used, what kind of limitations apply to the information, what kind of assumptions have been made as well. And as you can see, The metrics shall also consider the SASB standards, and we'll talk about that a little bit later. Metrics can, finally, they can come from a source of guidance other than what we produce. So if there's an industry or sector-specific information on metrics, you're free to use that. Once again, it's explained and disclosed appropriately. Next slide, please. So then we come to targets, and targets, as we know, may be set by the entity, or in some cases may be required by law or regulation, or even voluntarily by a sector. And a company is expected to clearly label and define that target in its disclosure. And when it does so, it has to include a number of pieces of information. So for example, whether the target is qualitative or quantitative, and whether it has been set by the company, or whether it's been set by law or regulation. The metric used to set the target is important, and how it's monitored, how progress is monitored over time. The period over which the target applies, is it a short, is it a medium, is it a long-term target? And when does it, what's the base year? When does it apply from? You'll often see net zero targets being set way off into the future, 2040, 2050 or beyond in some cases. If the company has set interim targets or milestones, they should also be disclosed. And performance against each target and an analysis of the trends or changes in that performance should be included. Anyone familiar with SBTI will know that revisions and updates are expected, and they should be disclosed. So, for example, if there's any changes to the target, no matter what the reason, they should be explained and disclosed. Next slide, please. I think we have a poll. So, again, using the chat function, if you could answer the following question. Metrics for sustainability-related financial disclosures should be connected to A, the CEO's tenure, B, financial material risks, C, financially material opportunities, D, targets, and E, strategy. Okay, just looking at those answers coming in. Good selection, yeah. There's some clear favorites, but lots of people are saying B, C, D, and E, or combinations of them. And thank you very much. You're right. Absolutely, you're right. All of the answers here except for A. But maybe if things are really bad or go very badly, then maybe the CEO's tenure is in question. But initially, at least, answers B, C, D, and E apply. Thank you very much. Can I pass it to those? Mike, I think we're back to you, are we? Oh, sorry, no.
Yes, no, this was, here we have an example about metrics and targets. And this example is about ArcelorMittal, which is a steel making company, steel manufacturer. And it's about the targets they use for decarbonisation. So in this disclosure, we can see clearly what their targets are. Targets are to reduce intensity of carbon by 25% globally and 35% in Europe by 2030. So the target's very specific there. They've actually designed the target to meet different regions. We see the scope of the target. So they tell us the target covers scope 1 and 2 for steel and mining per ton of crude steel. We see the longer term ambition too, which is to have a leadership position and achieve net zero steel making globally by 2050. We see that they've set out their roadmap from 2021. We know what type of investments they're making, and I think they mentioned an investment there of $10 billion to contribute to their targets. We also see what the dependencies for their success are. So they tell us they need policy making and a supportive regulatory framework. We also see the assumptions behind their plan to deliver. And actually, if you look at this report, you'll see on the next page that they give you what they call a waterfall chart, which shows you what this strategy looks like in terms of the target achievement up to 2050. Next slide, please.
This is where you hand over to me.
Handing back to you now, not Mike, but just so you know, we can't hear you.
Can you hear me now?
Still can't hear you, Mike.
Can others hear me? They can hear me. Lois, you can't hear me, but but I can see in the chat that people can hear me, so I will continue. So with that, we've got one more section to get to before the a short break that we will take, and this is around aligning your disclosures with additional disclosures that you might make. So let's go into why you would make additional disclosures, and some of these you've actually mentioned in your comments, in your questions, actually, to inform, for example, other stakeholders. That was a question that came up a number of times. And by the way, thank you for bearing with us. We have answered 65 questions already. That's more than one a minute. And we want to make sure we answer your questions thoroughly. So, we will get to your questions, but it might take a little bit of time. But one of the reasons might be, as I said, to inform other stakeholders. Maybe your industry has very specific elements that might require additional disclosures. We had a question around industry, the insurance industry. Maybe there are specific policy objectives in your jurisdiction that might require you to disclose additional information, or your stock exchange might as well ask for additional information based on a number of reasons as well. So there are a number of reasons that this might happen. In addition, as you evolve your disclosure from the TCFD, you might also consider how you would move from that disclosure to sustainability disclosures in line with the IFRS standards. Now, the good news is that the ISSB has actually published a mapping document mapping the similarities and the differences between the TCFD recommendations and the IFRS as two standards. And the good news is that there are many differences. Really, the ISSB's S2, IFRS S2 provide more detailed requirements to help you with more consistent disclosures and give you a bit more guidance on what to report. And with this, the TCFD actually concluded that this is the launch of the ISSB standards marks the culmination of its work and really handed over the monitoring of climate-related disclosures to the ISSB. This was because, as I mentioned, the ISSB has incorporated and really based its standards on the TCFD's structure and content, but of course expanded it beyond sustainability as part of S1, and thereby we can move one more alphabet soup, a member of the TCFD, from the number of initiatives that we have to comply with and implement. Now, it doesn't mean that the TCFD is gone. It really just lives on in the ISSB's standards. If for some reason you are required to continue disclosing using the CCFD? Of course, that's a different question, and you must, of course, look around any sort of compliance issues that you might be liable to. As I mentioned, there's a helpful mapping document that is available on the IFRS Foundation website. We have the link there. As Vanina has mentioned in the chat, the slides will be shared with you, so you can click on that as well. So don't worry that you don't have to write that link down. And as I mentioned, the good news is that it's really just building on what is already there, providing a bit more specificity to help you provide the information that your investors need. Another important development was the development of European sustainability reporting standards. And actually, when you were talking about what standards you're already reporting in line with, one of you have actually mentioned these ESRSs, the European Sustainability Reporting Standards. Now, even though you might be a Saudi company, you might be thinking, well, why do I need to care about these European standards? That's because these standards and the overall requirement, which is part of the European Corporate Sustainability Reporting Directive, do require certain companies that have significant operations in Europe to still comply with these standards. Or you might be part of the supply chain of a European company or other company that operates in Europe, so you might be affected sort of down the line with information requests. The good news here is the ISSB and the European standards developers, the EFRAG, have been working very closely to ensure that there is really a high degree of alignment when it comes to, in particular, the climate-related disclosures. That's sort of the first main work of the ISSB, making sure that there's a strong core in the middle that is aligned, and there might be additional requirements both on the European or the ISSB side of things. But there's a healthy core in the middle that avoids duplication of efforts. And so these are a couple of examples of how you might build on this. The European standards actually take into account that double materiality approach that I mentioned. So it's both the sort of the financial materiality and the impact materiality side of things. This is a perfect example of how this building blocks approach works that I mentioned earlier. You have the global baseline of the ISSB standards, and then you add to that bolt-on additional requirements that might be important for you to disclose, whether that's from a compliance perspective or other sort of drivers that might be driving you to provide that information. So let's have a look at an example. And this example is from Novo Nordisk, their annual report. And this is a really good example of explaining, where you're coming from in terms of your reporting. You have a description around how the information was consolidated, where the information came from, be that the emissions data or other sort of social or governance related information that the company is reporting. It then talks about the accounting policies it uses and how they may have changed. So really giving information around the nuts and bolts of how the information was prepared. And then the last one that you can see here on the right-hand side of the screen is the general reporting standards and principles that were used. So this is a Danish company, so they had to comply with the Danish Financial Statements Act, but they also used the TCFD recommendations, used 2-degree scenario and 1.5-degree scenario and a 4-degree scenario as well. And they have also have done their reporting in accordance with the CDP's questionnaire as well. So it provides a clear summary of all the different drivers behind the reporting. And we'll actually talk about compliance with the ISSB standards and how to do that later on in the course. But one last poll question for you before we break for 5 minutes to give you a bit of an opportunity to stretch your legs. So the question is, and you need to think about what your reporting strategy should consider. So should it consider the ISSB standards only? Should it be the ISSB standards and your regulatory requirements? Just the regulatory requirements, the ISSB standards, regulatory requirements, and any other frameworks or standards that help with management's communication objectives. So in the chat, please let me know what you think the correct answer is. Definitely D, somebody said. I would agree with you. Now, it's important that you take into consideration the legal requirements. That's an important element. Now, of course, in many jurisdictions, the ISSB will become legal requirements, but think about all the ways you can make sure that you get the information there to the investor that you need, or your other stakeholders. And in fact, the ISSB's S1 also talks about, how in the absence of other standards yet in other topics beyond climate, how to refer, which standards and guidances to refer to help you report all the information that you need to. But we'll get to this shortly. There's also a homework section around this area, and this is around sort of looking at your current state of reporting and how you get from where you are to where you need to be. So one element you could do is to conduct a gap analysis to see where you have information and where you might need to disclose more. And actually, in the homework assignment, there's a simplified checklist that you can use to really sort of go through your reporting and see whether it's included or not. It's a very simplified tool, but hopefully it will give you some ideas of, where you are, where you have some strength, and where you might want to focus on to complete your disclosures. So you can really get going with your first steps of reporting. So with that in mind, we have one Menti question for you to think about as we sort of break. What tools can you use to identify the gaps in your current disclosures? And the Menti should be live. I made sure in advance that this is working. So if you go on Menti, that should pop up, and you can type what you think would be most helpful. So we'll just wait a second to make sure that people are able to add things. Always takes a second for those answers to come in, I'm sure. If you're not sure what to do, you can just go on Menti, back to Menti again, and type in what you think would be helpful there. And you can just go to Menti and type in this voting code here, or you can use your phone and scan this QR code, and it will take you to the right section. Okay, I think it's taking a little bit of time, and I'm conscious that I want to make sure that we have to make sure that you have a quick break. So if you wouldn't mind, please, I believe it's 2:02 in Riyadh at the moment. So if you could take 5 minutes and rejoin at 2:07, and then if you could think about what these tools can be and use the chat function as well to answer that question. So with that, we have a quick break, and we have a little timer here to count us down to get us over the break. So see you back in 5 minutes. Welcome back, everyone. Hope you managed to get a quick break. And with that, we will get back to the session, and I'll hand over to Lois to talk about implementation. Over to you, Lois.
Thank you, Mike. Thank you. Just to reassure you, we are here. So we're going to talk about implementation. If we can move to the next slide, please, Mike. Thank you. Of course, I should say at the outset that the standards are about disclosure, about what you should put in your general purpose financial report. And there is relatively little in the standards about the actual steps that you would use inside a company to implement processes that you will need to support your disclosure activities. So I'm just going to take you through 3 things that can give some insight into what those types of processes could look like, whilst also stressing that the standards do not set out a process for implementing your disclosure practices. So first of all, we're going to look at how to identify sustainability risks and opportunities. Secondly, how to evaluate the materiality of information. We won't look at scenarios today just because of time, but in both cases, both to determine material information and to assess resilience, management needs to evaluate different options. So that is the process that should be used. And thirdly, we're going to look at how you can integrate all of this through the development of new processes or the use of existing processes into which you can integrate sustainability-related financial information considerations. So on the next slide, let's jump into how to identify sustainability-related risks and opportunities. Next slide, please. Now, I noticed some questions on the slide about the ISSB's focus on financial materiality. I've noticed other questions about, when are we going to deal with natural capital, etc. So this is quite an important slide to answer some of those questions. If you look in the second paragraph of S1, you'll see that the text describes an entity, its resources, its dependencies as an interdependent system, and that value is made, or cash and financial results are made through that interdependent system. So the standard recognizes that many factors give rise to sustainability-related risks and opportunities. And when we say sustainability-related, that includes risks to biodiversity, nature, human capital, etc. It's just that for the moment, we only have a specific climate-related standard. As you might know, the ISSB has had an agenda consultation asking the public, everybody, what they would like the ISSB to do next. The results of that consultation will be published next year, so we might get to a natural capital or a biodiversity standard, so keep your eye on the ISSB news site for that. But generally, what the standard says is that sustainability-related risks and opportunities come from interactions between the company and its stakeholders, so with whom it works and serves, its supply chain, etc., with society, and with nature from which it draws resources and upon which it has impacts. So together, the company and the resources and relationships throughout its value chain form this interdependent system in which the company operates. So whilst the standard wants material information about what is financially material, that is not to say that in terms of a process for identifying sustainability related risks and opportunities, that things like impacts on nature and society can be ignored. They can't be ignored because they are factors that give rise to sustainability related risks and opportunities, but the standard does not require information about them unless it is material from the financial materiality lens. So if we go to the next slide, let's look at an example of the types of disclosures we see about this. So this is an example from Yara, which is a global agriculture company. Now, Tiffany mentioned right at the start of this presentation that the World Economic Forum issues a risk report each year, and Yara is telling us at the top of this slide what types of mega trends are influencing the way in which it looks at risks and opportunities. So they've identified mega trends that shape Yara's market and value chain, including climate change, water safety, dietary health, soil health, waste and the circular economy, agriculture and food industry integration, and digitalization. Now, from those mega trends, you'll see, sorry, the bottom panel is slightly obscured, but from those mega trends, Yara has identified specific risks and opportunities that they are actively monitoring and watching. So they, on the risk side, they look at environmental costs and taxes and how they might increase their costs. On the opportunity side, they're looking at whether they can use digital tools to enable new markets and new channels of distribution, and also to improve yields. So this example shows us that the risks are identified both through looking at global trends, a wide range of subjects like population numbers and geopolitical and trade uncertainty. But what Yara has done is translate that into their specific risks and opportunities for their company. So if we look at the next page, please, connecting the dots. From what I described earlier, you'll see that the risks and opportunities come from understanding resources and relationships that a company depends on or affects. And these can take different forms. Those of you that are familiar with the integrated reporting framework will know that that describes them in terms of capitals: natural, manufactured, intellectual, human, social, and financial capitals. These are the forms of resources and relationships that can inform our view of risks. They can be internal resources and relationships, such as the ability to nurture, attract, and retain talent. They can be external, such as relationships with suppliers, distributors, customers, partners, and so on. And you'll see that IFRS S1 does provide examples that illustrate the relationship between the value a company creates, preserves, or erodes, and its own ability to succeed. So let's, on the next slide, have another look at this, how this is actually depicted. But this is an example from Vale, which is a global mining company based in Brazil, I think. And sorry, it's a bit of a busy slide here, but what I wanted to indicate was that using the integrated reporting model, actually, they show you on the left-hand side what their business model has and what it depends on, what it interacts with in terms of financial, human, intellectual, manufactured, natural, and social and relationship capital. So you'll see for those people who have asked questions about natural capital, you'll see that the company is describing how much water they've withdrawn, how much energy they've consumed, how many hectares of land are occupied by their own operations, and how many of those hectares are in protected areas. Then in the middle of the diagram, you'll see the business activities through which these inputs are processed in order to make the outputs that the company sells and delivers. So you get the sense here of all of the relationships and resources and how risks might arise from that whole system of inputs, outputs, and outcomes. On the next page. Of course, the standards recognize that because we only have a climate standard at the moment, companies who do want to report on biodiversity or human capital, what would they need to do? Well, starting point is to apply the appropriate IFRS sustainability standards. So in the case of climate, you have that, and we see that on the right hand of the slide. If you don't, the S1 does point to different sources of guidance that companies can use to inform their disclosures about subjects not currently covered by the standards. So the first thing to do is companies are required to consider the SASB disclosure topics. You can see all of the SASB standards from the IFRS website, and you can easily look up your own industry, say metals and mining, chemicals, and you can find what disclosure topics the SASB standards find to be most material for that industry, and that can inform your view of identifying risks and opportunities. And there are other investor-focused sources of guidance. So the little thumbnail you see at the bottom on the left-hand side is produced by the Climate Disclosure Standards Board that's been integrated into the IFRS Foundation. And there you'll find application guidance for biodiversity and water and social related disclosures. So there are sources of guidance to which you can refer when you want to report on something other than climate that's a sustainability risk. So on the next slide, I'll just cover this one briefly because we've talked about it a little bit. And that is that in determining your risks and opportunities, you simply use all reasonable and supportable information available at the reporting date without undue cost and effort. So this is information that's specific to your company, as we saw with some of the examples, that takes account of conditions in the external environment. And we saw that with Vale and Yara. That includes information about past events, current conditions and forecasts, and that takes account of what the standards prescribe. I did see a question in the chat about to what extent does our CRM, which I think you must mean compliance risk department, get involved. And of course you have a lot of sources internally that you can interact with to find out what might be the most material risks and opportunities. So you can look at your risk management process, but also what your industry and peer groups are reporting in terms of risks and opportunities, what you see from external ratings and from reports and statistics. So on the next slide, I think we have a little Zoom poll. Again, please get ready to put your answers in the chat. Now, let's say you've identified, as Yara did, that water is a vital input to your business, but the ISSB standards don't currently have a specific water disclosure standard. What do? A, disclose nothing. B, consult the sources of guidance listed by the ISSB. C, engage a consultancy to help. D, copy your competitors' reporting. What do we think? Yes, the answers are coming through. B and C are the most popular ones. I think with D, some people are putting D, it's fine to be inspired by your competitors' reporting, but not to copy it, of course. As you'll see from the examples we're giving you, looking at what peer companies are doing, it can be very inspiring in terms of how to prepare your reporting. But yes, most of you have this exactly right. B and C, of course, if you wish. So moving on to the next slide, we're going to turn to the second part of the implement module now, which is about evaluating materiality of information. So on the next slide, let's first look at the definition. Information is material if omitting, misstating, or obscuring it could reasonably be expected to influence investor decisions. The accountants on the line will know that this definition is based on the IFRS accounting standards definition of material. And to those of you that have been asking about interoperability, we are seeing with other standard setters some coalescence around this definition to the extent it applies to financial materiality. On the next page, let's look at a bit more about what is said about materiality in the disclosure standards. So we know that information is material when it influences primary users' decisions. We went through this list earlier, but it's their decisions about whether to provide resources, buy, sell or hold equity and debt, provide or settle loans and other forms of credit, or exercise rights to vote or influence on management's actions. So that's the first thing, but not necessarily in order. It's one of the factors to take account of in determining what's material. Will it influence my investors? Secondly, in doing that, you have to consider the characteristics of the investors in the company's own circumstances. So I'm sure you know that many companies have investor days, and the characteristics of the investors are often known from those investor days, but they will need to be taken into account in determining materiality. And you can assume that these investors have a reasonable knowledge of your business and economic activities. Of course, we're well aware that different investors have different and sometimes conflicting information needs, but the standards and the disclosures are intended to meet the common information needs of investors. So you don't need to sort of kind of break down information to respond to very niche or specific subject investors, have a particular interest in a certain thing. It's for the common information needs of investors. On the next slide, bear in mind when you're thinking about what the investors want, they want to understand whether, how, and to what extent environmental degradation, social challenges, macro trends, or specific trends to your business affect inputs to your business, relationships, and your performance. Secondly, how the company is managing those sustainability-related risks and opportunities through its plan or strategy or plans for the business model, plans to respond to actual or potential regulation. Investors might want to understand the assets that you hold and how they are affected. Are they at risk of becoming stranded, for example? How the company's governance body takes account of these risks and opportunities when designing strategy and making decisions is also important to investors. And of course, they'll want to know how resilient the company is to possible future risks in different scenarios. And we've seen some examples of how that's disclosed. So on the next slide, let's do a summary of some of the tests of making a materiality judgment. Materiality isn't determined by reference to an individual risk always. It might be necessary to take account of whether an item for potential disclosure is material individually or in combination with other information. So what is the materiality when taken in the context of the company's sustainability disclosures as a whole? Are both quantitative and qualitative factors taken into account in making the judgment? Yes, they should be, and they both are relevant to the evaluation of materiality. The potential effect of future events is difficult, of course, but should be considered in terms of making materiality judgments. So taking account of the timing and the uncertainty of those events on the company's future cash flows under different time horizons. And finally, it's helpful in the evaluation to consider the range of possible outcomes and the likelihood of possible outcomes within that range. I see some of you have asked about the involvement of the risk department, and what you might want to consider here is whether the range of possible outcomes are actually being catered for in the risk management department and in your mitigation strategies that might influence the evaluation of materiality. So on the next slide, there is guidance in the standards on making materiality assessments, but we just want to point you to a few resources that could also help. These come from the World Business Council for Sustainable Development, who have quite a few publications of interest on risk management and materiality. But they say that in evaluating materiality and putting in place a materiality assessment practice, There must be a clear purpose. You must know the time horizons over which materiality is being assessed. It's important to compare the results over time in case anything about the assessment process needs to change. Different perspectives should be used. So, of course, sustainability being such a multidisciplinary consideration, different perspectives, perhaps from economists and risk management professionals will be necessary. But you can see from the list here, I won't go through, that there are these resources can help in the process of evaluating materiality. Now let's look at an example on the next slide. This example comes from Philips, which I think I describe as a healthcare company based in the Netherlands. And they're setting out here how they did their materiality analysis. I should stress that the ISSB standards do not require you to set out a materiality analysis, how it's being conducted in terms of a matrix like this. Companies often use a matrix, but it's not what the standard requires. But this is one possible way of communicating to your investors and others how your materiality analysis and evaluation is being conducted. So you'll see that they are in their matrix. They're showing us matters of internal importance on the bottom axis and external importance on the other axis, and they are distinguishing different types of potential risk using symbols. So a black square for environmental, a blue dot for social, and a diamond shape for governance. And they're ranking them in terms of the impact and probability of the risk, and maybe using other criteria too. But let's go on to the next page to see what happens then. Now, a number of you have asked about double materiality, impact, and financial materiality. And I think this is quite an interesting way of seeing how Philips actually set this out. You'll see that the financial materiality bars of risk exposure are on the left and impact on the right. Although we haven't got time to analyze this in detail on a line-by-line basis, you can see quite clearly from this diagram where the greatest impact materiality is and where the greatest financial materiality is. Now, on climate change, we have something quite similar on both sides. On other issues, you'll see that there's quite a divergence, like innovation and research being very important for impact materiality, but perhaps less important for financial materiality. But it's quite an impactful way of describing the links between financial and impact materiality, but also the differences between them. So that's from Philips Annual Report 2022. So let's move on to the next slide. I said earlier that when judging whether information is material, we need to look at possible future events. And it is difficult because outcomes are uncertain to know whether it's material. But the process, if you like, the evaluation process, is to consider all pertinent facts and circumstances that could affect those outcomes, the potential effects on the amount, timing, and uncertainty of the company's future cash flows over different time horizons. The criteria used, often probability and impact, are used for evaluation, but the standard actually says that low probability and high impact outcomes, as well as possible future events judged to be more likely to occur and with significant potential effects, should be considered. As we said before, you need to take account of risks individually and in aggregate. And finally, the materiality judgments should be reassessed at each reporting date in case things have changed. So let's go to a Zoom poll now. So what we should say here is material information should be disclosed or should be disclosed when applying ISSB standards if. So be ready to put your answers in the chat, please. A, omitting it would alter an investor's decision. B, it affects the company's ability to secure resources. C, it has been determined to have no financial impact on the organisation. D, assumptions used to assess materiality have changed. So let's have a look at the answers. Yes, many of you have A, B, and D, which is correct. All of those things are relevant. I think the only one that is potentially wrong here is information should be disclosed if it's determined to have no financial impact. Certainly for the purposes of the ISSB standards, if the information is to be determined to have no financial impact, then it is by definition not material and not necessarily to be disclosed. So I would say A, B, and D. And many of you have this. But we are going to look at an example in a moment where we see an example that potentially falls into C, so bear that in mind. Let's move to the final part of this implementation part of our training. And this is about processes and integration of new considerations into processes you already have. So on the next slide, what we're talking about here is the possibility that management will assess existing systems and processes to determine whether they are fit for the purpose of sustainability-related financial disclosure, or whether new systems are needed, or whether some adaptations to the existing processes are needed. So how could this be done? First, by conducting a gap analysis. Have we got everything we need in our existing systems and processes to enable us to report sustainability-related financial information? B, are our processes suitable? C, what criteria do we use? Now, in the examples that we've looked at, we've really talked about impact and probability. But actually, if we look at something like the COSO guidance on enterprise risk management and sustainability, we'll see that other criteria commonly apply to sustainability risks, including vulnerability and speed of onset. So maybe consider whether other criteria are needed to get to sustainability-related financial risks and opportunities. Fourth, what controls are in place for the mitigation and management of risks and information? Next, who will contribute? What departments have relevant processes and expertise to contribute to the development of sustainability-related financial disclosures? And ultimately, interconnections. Are there existing processes that need to be linked to other processes and systems to deliver sustainability-related financial information? And do we need to look at interconnections between different internal and external factors, as we saw from some of the examples? Finally, how are we going to manage uncertainty through processes? Will this be done through risk management, governance and finance processes? Is there something in place that could be adjusted to take account of the uncertainties and the unique characteristics of sustainability-related risks and opportunities? These are questions that need to be asked in evaluating our processes and systems. So let's go to the next slide. Of course, part of the homework is to develop a reporting strategy, but by asking and answering some of these questions, they help a company to manage their internal processes and systems in various ways. And a reporting strategy is what that all adds up to. So the benefit of the strategy is that companies have told us it helps them take control of their own narrative. because they know how they have limited or balanced conclusions and opinions, and they can perhaps speak to some of the conclusions that could be reached by investors, so they can take control of that narrative. This reporting strategy supports internal collaboration because it will set out how knowledge is to be shared, how cross-functional teams work together from different departments, how communications will be managed. I think Jarlath will come on to that. And the reporting strategy then acts as a permanent record, if you like, as a reference point and an audit trail for documenting, explaining, and managing the process of preparing disclosures, including where and how judgments have been made. So if we go to the next slide, we have an example. It's a bit like the one Mike showed from Novo Nordisk earlier, but what Hammerson, which is a property company in the UK, are doing here is they're setting out the basis on which their reports have been prepared. So on the left-hand side, you'll see they have an ESG data book, and this is almost like their strategy for data. They set out how they have approached the collection of data, the involvement of staff, the management of uncertainty, all this type of thing. And they tell how the information has been presented, where the information is, what types of entities from their group were included in the reporting, and also describe their voluntary disclosures. So you can see they make reference to GRI there. So this is becoming a slightly more common practice now for companies to set out how they have approached their disclosures in terms of methodologies and other approaches. So on the next slide, we have another poll. You're all very good at this, so I'm expecting 100% success. A reporting strategy is required by the IFRS Sustainability Disclosure Standards. Is this true, yes or no? Very interesting. I think I see all A's. Yes. There's two things to say here. The first is, somebody has put no. In terms of the requirements set out in S1 and S2, there is no requirement or paragraph that says a company is required to have a reporting strategy and to disclose it. So in that sense, answer B is correct. There is no such requirement. However, one could argue that a reporting strategy is necessary to do all the preparatory work, all the preparation that is needed to prepare the sustainability-related financial disclosures. So strictly, no, but in practice, yes. So I think whether you wrote A or B, you have a point, but strictly the answer's no, B. So let's see what's on the next slide. I wonder if we can miss this one in the interest of time, because I think everybody will know this one. Let's go on to the next. Yes, so the homework activity, this is the third part. From the implementation point of view, the homework is to think about existing systems, whether and what type of gaps there are in them, what to do about those gaps, whether you need a new system or process or a modified system or process, whether there's systems in place to collect data, how it could be collected more efficiently or collected at all if not currently done so, and also data management. How is the data going to be managed? Who are the teams that will be responsible for it? What synergies can you capitalize on? Are there things that can be made streamlined across the organization? So these are questions to ask in developing your reporting strategy. So I know now we've got a mentee, Mike, so I might hand back to you for that.
Yes, thank you, Lois. So based on the homework, our next mentee, and we hope this time it will actually work, what existing systems and processes for data collection can be adapted to collect data on sustainability-related metrics. So if you go on the Menti again, and send us your thoughts. I checked it, so it should be working. And again, it goes back to the fact that you might not need to start from scratch. You might have some good processes or systems or tools already available that you can use to adapt to collect metrics on sustainability as well. If the QR code is not working, you can just go on menti.com and you have the voting code there. You type that in and it should take you to the right session. I can see Jalith is checking for us as well. So if you could confirm that you're on there, that would be very helpful.
Please wait, Mike.
Hey, Mike, when I use the Menti, it says what tools can be used to identify the gaps. Have you changed to the next Menti slide?
I did, yes. Let me double check. So I can see the right question on my screen here.
And it says for me, please wait for the presenter to show the next slide.
Yeah, me too.
Just restarting the session on the Menti just to make sure. I think it's going to work in a second. Let me just find the right question here. Okay. It should hopefully pop up now.
Yes.
Great. Okay.
Great.
We got there in the end. Thank you, Tiffany.
No problem.
So once again, just think about what systems and processes you might already have that you can use. And I can see the first question come in. Excellent. So I'll share the screen so that we can see what the answers are that are coming in. All right. We have ERP systems, data warehouse, financial accounting systems. Excellent point. I think we've had a number of conversations with certain people from the finance teams who thought about the fact that if there's a line item for water bills, there might be water related data that can be collected alongside it, dashboards that you might have existing as well, or new systems like sustainability data management that you might already have, of course. So what else is coming in? Let's have a look. Excel, it's a tricky one. So it might be a tool that you might think of, but if you think about the traceability, the assurability, the audit trail of the information that you might have, it might be a bit trickier to use in the long run. So certainly it is. I'm sure it is used in many cases, but perhaps one to think about graduating from and moving to something a bit more rigorous. Yes, excellent answers throughout. Power BI also interesting one. All right, I think we got some good ideas here. So perhaps we can move back to the slide deck and move on to the next session. Thank you very much, everyone.
Thanks, Mike. So we're at the final module now, and we're going to spend some time thinking and talking about communication with investors. We've selected a number of examples for the next session, and Lois is going to help me digest each of them in turn. And just as a little reminder, of course, these examples are just provided to illustrate and are not endorsed or approved by the Sustainability Standards Board Foundation. Okay, so if we move to the next slide, please. We've broken this down into 3 elements. The first one is where we look at the location and timing, so where and how often to report. The second one looks at efficiency, how to communicate efficiently and effectively. And finally, then we'll finish by talking about confidence, how to maximize confidence in disclosed information. Next slide, please. Next slide. So, you should ensure that material information, as Lois outlined in the last section, is clearly identifiable, and that you use plain language to describe and discuss this. You should also ensure that material information is not randomly scattered throughout your disclosure. Now, you might find that you need to make additional non-material disclosures if the material information is not sufficient on its own to allow investors make take an informed view of your disclosure. So, for example, if they want to understand the effects of sustainability risks and opportunities on the company's prospects. Additional information might, for instance, be required also in order to explain the context within which these issues, risks, opportunities arise, or to enable material information to be understandable. So it complements the material information. We're not saying you must include it. By definition, you should only include material information, but you might find that it is helpful to include extra information. And this additional information should be distinguished from the material information to which it relates. And there are different ways of doing that. Next slide, please. So one of the most asked questions we get is, where do I put this information? And any information, any disclosures provided using the ISSB standards have to accompany the financial statements and be part of the same reporting package. However, S1 does not specify where in that reporting package the information should be provided. And this is important because the standards are designed to be used around the world with different types of regulations that are in place. And so it provides for and facilitates specific requirements in individual jurisdictions, which in some cases do state where this type of information should be disclosed. And the company may provide additional information beyond what's required if that information doesn't obscure the financial information that we're talking about. Let's move to the next slide. So some interesting analysis provided by the World Business Council for Sustainable Development has shown the trends in disclosure over the last 4 years. And it does continue to show integrated reporting features quite prominently by preparers and corporates. But in addition, standalone reports are also popular. Now there isn't necessarily a trend showing that standalone reports are decreasing. But the IFRS sustainability disclosure requirements set out that the disclosed information must be within the general purpose financial reports and not in a standalone sustainability report. You're still free to prepare a standalone report, but for the purposes of complying with the IFRS sustainability standards, that information must be in the main report. Next slide, please. One other interesting trend we're seeing is on the evolution towards digital reporting, and this is happening at different speeds in different jurisdictions. And what we see is increasingly corporate reporting is moving from a PDF, for example, or a web-based disclosure towards information in a structured, that is in structured data sets, such as, for example, what's offered or provided for by many exchanges around the world. The ISSB standards are available as a digital taxonomy, which is needed to make disclosures machine readable. Now, the information you disclose has a corresponding taxonomy or tag that makes that information easy to read, machine readable. And that really helps investors and others who like to aggregate and analyze huge data sets. It makes it easier for them to look at, for example, a sector, an individual sector, and all of the companies in that sector, and bring it together and run some analysis. And I should also mention just very briefly that reporting taxonomies are different to green taxonomies, which are used to classify what's described as environmentally sustainable economic activities. Next slide, please. Now, the benefits of digital reporting are mainly efficiency and cost. So, for example, first and foremost, as we talked about, it makes the information easier to read and easier to analyze if it's machine readable. Tagging of information also allows for automated checks on quality control and consistency and gap identification, for example. And more data collection and management systems are compatible with digital reporting taxonomies. Another interesting feature of taxonomies is that they can be quite helpful when it comes to analyzing reports in different languages from different regions. So if, for example, if you report your data in one language, somebody who speaks a different language or isn't familiar with that local language can still analyze and understand the information that you're publishing because it has been disclosed using a digital taxonomy. And next slide, please. I think we've got an example, Lois, if you'd like to take us through it.
Yes, this example is from Ayala, which is a conglomerate company. I think they deal in real estate and a number of other activities based in the Philippines. But since we're on the module, the part of the module is about communication, what we want to use this example for is to illustrate the way that on quite an early page of the report, page 48 to 49, you get this immediate depiction of how everything is put together in the integrated report. So in the middle panel, you'll see that how the company creates value using inputs from the capitals on the left-hand side, but the outlook, which they refer you to find more information about on their page 50, is the context that defines the company's strategy. You see the strategy, they give you the page number, and that guides how Ayala conducts its business activities, such as business development and capital allocation, whilst also mitigating risks and opportunities. And the idea in the end is to generate long-term value for the stakeholders that they list in the box, and refer you to a page where you can get more information on this. And the point really of the slide is there's no right or wrong way to enhance your communication and make it more understandable. But this is one way where we see a snapshot of the inputs and value creation model and the value generated on the right-hand side. And we instantly see where we can find other pages to give us more information about it.
Thanks, Lois. Next slide, please. So, we often get asked by preparers about the timeline and when they should be preparing this information. So the standards are effective from the beginning of January next year, so a few weeks away. However, jurisdictions and regulators and authorities and jurisdictions will themselves decide when to mandate adoption. There is transition relief in the first year of adoption for a number of provisions and disclosure requirements. And a company is required to provide sustainability-related financial disclosures for the same period and at the same time as its financial statement. So the sustainability disclosures and the financial disclosures it should be prepared and published at the same time. And in addition, a company is expected to make its disclosures for a 12-month period, and special requirements apply if there's a change to that reporting cycle, if it's greater or longer than 12 months, which can happen on occasion. Next slide, please. Thank you. I think we're up to Zoom. Oh, yes, excellent. So, again, using the chat, the question is, what should be the same for both financial and sustainability disclosures? What should be the same for both financial and sustainability disclosures? I've got some options here. The assumptions should be the same, the report should be the same, the timing should be the same, the reporting period should be the same, the time horizon should be the same, and the risk management process should be the same. Okay, so the answer is coming through. Do you want to answer this one?
I'm seeing a range of answers coming through. I mean, in theory, all of them should apply, ideally. But I think, and what some of your answers recognise is that, of course, in the case of E, time horizons, for example, quite a few of your answers have left out E. And of course, the time horizons are really likely to be different for financial and sustainability reporting. So some had left out C, timing of disclosures. I just want to draw your attention to the fact that in the first year of reporting, or the early years of reporting, the standard does allow for the timing of financial and sustainability disclosures to be different, because the standard does recognise it's going to take time to build capacity, and therefore it allows for the timing of the sustainability related financial disclosure to be slightly later than the financial statements in the circumstances prescribed in the standard. And of course, that will also be determined by your own jurisdictions and in the context of how they want to implement the standards. But in theory, yes, they should all be the same, but there are circumstances with assumptions, timing and time horizons and reporting period where that might not be possible, especially in the early stages.
Thank you. Okay, interesting one there. Okay, shall we move on to the next slide, please? I think we're on to the next section, which is on how to communicate efficiently and effectively. Excellent. Can we? Yes, thank you. So, some preparers on the call might be sitting there. Some of you might be thinking, okay, I understand a lot of this. And you might be wondering what all the fuss is about. You know, for example, perhaps your experience focuses only on standalone sustainability reports. Or, for example, you might not have had much interaction with internal or external audit. I guess what I would say to all the accountants still with us, I would say be kind to your colleagues, help them understand the difference in rigor that's required in data collection, in the systems, in the controls and the oversight, in the sign-off and approval steps, and so on, around an annual report. That's the key difference. It's quality of information, one of the key differences. So the standards, the IFRS standards require that disclosed information should be material, it should be connected and aggregated or disaggregated as appropriate. And the information should also include comparative information and be restated as necessary year on year. And you should also seek to minimize duplication and cross-reference appropriately. We've touched on some of these topics already. Next slide, please. S1 requires information to be clear and concise. And you can pick up any report and you could probably take a view on how well, how effective the report does this. The clearest form of disclosure can depend on the nature of the information. So for example, it could be a table, it could be a graph, it could be a diagram with some accompanying text. But to be concise, disclosures need to avoid boilerplate information, unnecessary duplication of information, and to use clear language. I guess the key thing here is we're talking about how you report, and the standards do not explain or prescribe how you shall report, because ultimately that's your job. It's your story to tell in your annual report. But these issues are important because they affect how you disclose the information. Move to the next slide, please. As a little reminder, why we report is important to remember. These standards exist and are relevant and important for investors because a company's ability to generate cash flows is linked to its interactions with stakeholders, society, the economy, and the natural environment throughout a company's value chain. We talked a little bit about this earlier. And together, the company and its resources and the relationships form an interdependent system. The company's dependencies and impacts on those resources and these relationships give rise to sustainability-related risks and opportunities. And remember, S1 builds on concepts from integrated reporting, which helps companies articulate how they rely on and depend on all of these capitals. Because ultimately, at the end of the day, these resources and relationships, they create, they preserve, or they erode value for investors over time. Next slide, please. I think we'll be on to an example here. Lois, are you happy to take us through this?
Yes, this is an example of from CRH's 2022 annual report. They are a cement and materials company based in Ireland. Now, do you remember earlier we had a question about a Zoom poll? If something does not have financial impacts, do we need to report it? And the answer was strictly not, because the standard's about material financial information. However, here we have an example to illustrate connectivity and perhaps to make us think a bit further about that Zoom poll. So at the top of the page, the title tells us that the disclosure is about the impact of climate change risks and carbon emission reduction targets on financial statements. At the start of the page, the company tells us where the risks that they're considering can be found. They're in their TCFD disclosures on pages 56 to 59, so we have good navigation there. They then tell us how the risks and the impact of the group's emission reduction targets have been taken into account in the financial statements. And basically, it's a lot to read while I'm speaking, but really what this extract tells us is that there is no material impact on the financial results, financial statements as a result of these risks. But in that middle section, you can see that the company refers us to relevant pages in the financial statements where impacts could have occurred on impairment, provisions, the useful lives of assets, and so on. So we know what they have considered. We know that this is part of their consideration of financial impacts and the carbon emissions reduction targets and strategy. So the judgments that have led to the conclusions have been made using the company's accounting policies and assumptions. So going back to our last poll, consistent and coherent assumptions and policies have been used to conduct this evaluation. And the companies tell us that they're aware that things change, there are ever-changing risks. So really what we can learn from this small extract is that even though there are no material impacts, we do know that the company has considered particular parts of the financial statements and whether there are financial impacts in relation to the line items listed in the middle of the section. So this is a judgment for management to make about communication. Is it useful for us to tell our investors that we have done the work and that we've reached a conclusion, and we're actually explaining the considerations and assessment for our decarbonisation strategy on our financial statements?
Great, thanks, Lois. So when we talk about consistent disclosures, what we're really thinking about is what kind of information can we provide investors to help them understand connections. And we talked a little bit about this earlier on. When we're thinking about connections, what we're looking at are the connections between individual sustainability related risks and opportunities. We're talking about connections within the sustainability disclosures. So for example, the 4 elements: governance, strategy, risk, metrics and targets, and that was 4, wasn't it? Governance, strategy, risk, metrics and targets, yeah. And also connections across the sustainability disclosures and the other parts of the annual report. And to facilitate the understanding of these connections, S1 requires that the disclosures are prepared for the same reporting entity and for the same reporting period as the financial information, and they're also provided at the same time as the financial statements as part of the same package of information. S1 also requires a company to use data and assumptions, as we know, in preparing these disclosures, but that they're consistent with the corresponding data and assumptions used in financial statements. And S1 also requires a company to provide information about current and anticipated financial effects of these risks and opportunities. Next slide, please. A question that comes up from time to time is about aggregation and disaggregation of data. I'm not going to spend too much on this, but I would like to just cover it briefly. Material information about a company's particular sustainability-related risk or opportunity, it's easier to understand when it's not scattered throughout its report. And if you pick up a selection of the reports, you'll see various ways of putting this information together. And again, there's no real right or wrong way to do it. But you tend to recognize a good example when you see it. And as a result, information should be appropriately aggregated, particularly when that information shares similar characteristics. I think we'll have an example in a minute. A company is required to base its decisions on how it aggregates this information based on its individual circumstances, as you would expect. However, aggregation should not reduce understandability, or it should not be used to obscure material information. Think about this the other way around. Disaggregation of material can be useful, for example, to show how sustainability risks and opportunities differ by, for example, sectors, if it's a conglomerate, or by geography, if it has operations in multiple jurisdictions or regions around the world. Lois, I think you're going to take us to an example on the next slide.
I think so. Yes, this is an example from Enel's 2022 sustainability report. Enel is an electric utilities company based in Spain, Italy, I beg your pardon. And what we see here is an example that illustrates the way that greenhouse gas emissions can be disaggregated or broken down. So in the top panel, we see that the carbon footprint is broken down by Scope 1, Scope 2, and Scope 3 greenhouse gas emissions, and we have the total. But we also have a comparative information, 2021 in the light green and 2022 in the dark green, so that it's easy to see the trends in the greenhouse gas emissions between those 2 years, and also where the majority of greenhouse gas emissions are in terms of scope. So that this makes the understanding of greenhouse gas emissions more understandable by disaggregation. In the bottom panel, there's been a further disaggregation whereby the company has broken down the greenhouse gas emissions by source and business line. So we see the global business lines, generation, trading, networks, end customers, and other. And by breaking down the greenhouse gas emissions in this way by business line, you can immediately see that the majority of Scope 1 greenhouse gas emissions come from the generation from thermal sources. So this is combustion of fuels for generation activities. Now you'll also notice that there are numbers at the top of each column, 1 to 6, and these numbers refer to notes. So for example, you'll see from note 1, which is on a page we haven't displayed here, the company explains that the greenhouse gas emissions are mostly from CO2, from carbon dioxide. So in this little illustration, you can really get a sense of where the majority of emissions are from. The last thing I should mention is that you see coloured dots against each of the numbers. And this is to indicate whether and to what extent the greenhouse gas source is included in one of the company's science-based target initiative targets. So with very little presentation, if you like, quite small diagrams, you get a lot of information because of the way that the company has disaggregated it.
Thank you, Lois. That's really interesting, really helpful. Okay, we're going to talk a little bit about cross-referencing here. When you pick up annual reports from companies, particularly those who have adopted voluntary reporting or disclosure standards, you often, not always, but you often see cross-references or tables with cross-references to information, which can be an effective way of addressing voluntary disclosure requirements. Now, when it comes to the adoption of the IFRS sustainability standards, cross-referencing is permitted as long as it's done so appropriately. So, for example, it has to be done on the same basis and at the same time, and with the outcome that information is not obscured or it becomes less understandable as a result of the approach you have taken to cross-referencing. It must also be as transparent as possible and explained and disclosed. I think next slide, we've got a whole, I might just skip this one and go to the next one, if that's okay, number 14. So again, in the chat with your answer, please. Information is decision useful if, and we've got 5 options. So information is decision useful if it A, is relevant and faithfully represented, B, is comparable, C, is verifiable, D, is timely, and E, is understandable. I think everybody is a winner on this question. Exactly, it is all answers apply. Thank you very much. Okay, we're going to move on to the final section now, which is confidence and maximizing confidence in the information you disclose. So, thank you. Comparative information provides context. I think we all understand this. It helps to indicate progress, and it underpins strategy and risk management. The information can be qualitative and quantitative, and as we covered already, errors should be restated. And I should also mention that, again, in the first year of reporting, a relief is available. So, for example, if you don't have preceding year's data, obviously you don't have to disclose that. You should just begin reporting, and then in the following year you will have your comparative information to draw on. And there's more information in the standards on this if you're interested. Move on to the next slide. Another interesting question we get sometimes is about commercially sensitive information. And there's no expectation that you need to disclose commercially sensitive information in your disclosure, as long as it's not public information already. And the company needs to be, your entity needs to be transparent about the exemption if it's being used. So for example, if providing this information could negatively affect its future prospects, and that should be disclosed appropriately. We'll move on to the next slide. We saw some questions earlier in the chat about estimates, particularly when it comes to scope 3. Estimates are expected, it's part of what happens. And companies can use reasonable estimates when preparing sustainability-related financial disclosures. However, the information is required to be accurate and provided in such a way that it enhances its verifiability. But that doesn't mean the information has to be perfect, and we all know it can't be in all cases. Reasonable estimates are required to be based on information of sufficient quality and quantity. Estimates are, though, of course, approximations that will be revised over time as you put together better information or you get better at your disclosures, or as more information becomes available. Judgments about the future are also likely to be particularly uncertain. But information about the future and how it informs your scenarios, for example, must reflect both the judgments made by the organization, the company, and the information on which you've based those judgments. And reasonable estimates can be used where there is measurement uncertainty also. Next slide, please. The reporting entity or organization must include a statement of compliance that it has conformed with all of the requirements set out in the ISSB standards, except where in the first year of implementation, for example, release apply. That's permitted. And we do expect to see a statement, an explicit statement of compliance in your disclosure as a result. We'll move to the next slide, please. So this is a nice little summary slide, and it covers the main things to remember when you're preparing your sustainability related financial disclosure. First is the information being provided relevant, material, and is it faithfully represented? Second, will the information provided allow investors to understand the connections between, within, and across the sustainability related financial disclosures? Third, are the sustainability related financial disclosures being provided for the same period and for the same reporting entity as the financial statements? Fourth, do the disclosures cover all material information that investors need, including disclosures on the core content covering governance, strategy, risk management, metrics, and targets? Fifth, has comparative information been included for the preceding year if it's available? And finally, if all of these requirements have been met, have you included a statement of conformance or compliance? Next slide, please. I think we're onto a poll again. So what type of information qualifies as commercially sensitive? Again, answers in the chat. A, information that's not already publicly available. B, information that could be reasonably expected to prejudice seriously the company's economic benefits. And C, marketing information. And yeah, I think we see the answers are coming in correct, A and B, and it must be both. It's not A or B, it's A and B together. And then I'm going to, thank you, I'm going to move on to the next section, which I think is homework.
Charlotte, I'm going to take over for you now, if that's okay, because I've been given the very tough task of somehow finishing in 6 minutes. So we're going to have to skip this homework, unfortunately. Thanks everyone. So just to let everyone know, the homework and the next portion of it we were going to discuss is what techniques do you find useful in a report that you can already use. And again, I think you might be getting the trend here is that we're trying to point out that there are practices and processes already in place in your organization that you can continue to use as you make use of the IFRS standards. Great. So as a reminder to everyone, you do have that homework online, and we're going to keep going, actually. Vanina, thanks. We're going to whiz through the homework assignment and go all the way to the next Menti so that we can get a sense of what you did learn. Great. Thanks so much, Vanina. So we have this Menti already launched. And we'd just like to get a sense, and Mike, you can go ahead and share your screen and let everybody see what everybody is putting in there. Great. We wanted to know from you what you picked up from this training so that we can continue to improve it. This is a training that's constantly being adapted and adjusted. So please let us know what parts of that you liked, what parts we should make sure we keep in the training. And we see examples are here, and the experts, you particularly like Jarlath and Lois, so please stay with us, Jarlath and Lois. And the content, the mentees, examples is getting bigger and bigger, so of course those examples are very useful, and Lois is so good at explaining them as well, so we very much appreciate that, Lois. Great, thanks for those initial ideas. Maybe we move on to the next Menti slide now, Mike, now that we have a sense of what to keep. And we'd like to know how much you learned. So at the beginning, we asked you how comfortable you were with each of these tasks. The first task being explaining to team members the purpose of the ISSB. The second task being identifying the sustainability related information that investors need. And the final task being developing a sustainability reporting strategy. Good to know that it seems like those numbers have increased during the training, so I'm glad you're more comfortable with that. I do hope, though, that you take the time to do that homework assignment. As a reminder, you can find that homework assignment on our website, and I will get Vanina to share that again in the chat so everybody has it, but we will send it to you also tomorrow. Zoom will send you an automated email, and you'll get all the links in that as well. So we would like you to take the time to do that homework, think through that disclosure strategy, think through everything we talked about today, and that will help you to be on the right foot as you move forward in this journey. All right, thanks so much, Vanina, for sharing that. Oh, we seem to be sharing the SGX one, but that's okay. we still have this, it's the same slide deck and same homework. Great, so now if we want to move back to the deck, we have 2 minutes, and I just want to share with you all how you can get your certificate. So if we move forward all the way to the certificate, great. So if you would like to get a certificate for participating in this training, you did spend your whole afternoon with us. We really appreciate your time, and we hope that you found it very useful and that you can continue your learning journey from here using the IFRS Knowledge Hub, as well as other training opportunities that are coming soon. So please just use this QR code or the link in the chat, or you'll also be emailed this link tomorrow from Zoom, and fill in that feedback survey anytime in the next 14 days, and we will email you back with a certificate. Now, we do ask you in that survey if you have completed the homework, so it's highly recommended that you spend a bit of time first to be able to think through your disclosure strategy. Somebody here said to share the email. The email you will get automatically from Zoom, so you will be receiving all this information directly from Zoom. Now we can go to the last slide, Vanina. Great, thank you so much. Really want to thank our host today, the Saudi Exchange, for having us come in and do this training with you. And I'd like to, of course, thank our partners in this, Lois, Jarlath, Mike, thank you so much for your great facilitation and for answering all those more than, I think, 80 questions. It was a lot of questions that were being answered very quickly. So I hope everyone got the answers they needed. Thank you very much, everyone, for your participation, and we look forward to seeing you again online sometime in the future. Take care, everyone. Have a great day.